To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
So let's now start Ind AS 21 that deals with the effect of changes in foreign exchange rates. So here we are talking about what will be the effect of changes in foreign exchange rates. The corresponding standard under the Indian GAAP is AS 11, and lot of concepts what you have learned in AS 11 are still applicable in Ind AS 21 as well, but there is one fundamental difference where Ind AS 21 introduces the concept of a functional currency. Now, before I jump into the standard, before you understand what is the impact of changes in foreign exchange rates, we need to be clear of three terms. The first term is the presentation currency, then the second term, the most important one, which is the functional currency, and third is a foreign currency. Okay. Now, what is this presentation currency? What is this functional currency? To understand that, let us take a very simple example. Say we have Amazon India and Amazon US. Amazon India is incorporated in India under the Companies Act. Amazon US is incorporated in the United States. Now, if I were to ask a question, in which currency will Amazon India prepare its financial statement? In which currency will Amazon India present its financial statements? The answer is pretty obvious. The company would prepare and present its financial statements in INR. Similarly, Amazon US will prepare and present its financials in USD. So, this INR for Amazon India is a presentation currency. Similarly, USD for Amazon US is a presentation currency. So, what is a presentation currency? Presentation currency is basically the currency in which the entity prepares and presents financial statements. Okay, so that is what is a presentation currency. Now, it may be possible that Amazon US, because it is the holding company of Amazon India, Amazon India is also maybe listed in the US stock exchanges. Amazon India is also required to prepare financial statements in USD. So, when it presents financial statements in USD, then that is called the presentation currency. So, normally if you see any company which is incorporated in India, what would be the presentation currency? INR. Now, coming to the second one, the functional currency. What is this functional currency? Functional currency is the primary economic environment in which an entity operates. Now, what is this primary economic environment? What is this operates in a primary economic environment? Say for example, we are talking about Amazon India. First, let us assume Amazon India has all its businesses in India, all the sales, all the purchases, or major sales and major purchases, the major receipts and payments, all of that happens in India. If Indian economy goes down, it will impact Amazon India. The transactions happen in INR. So, in that case, we can see that INR is the currency of the primary economic environment in which Amazon India operates. Now, if I have to change this example slightly and let me bring in a third country, let us say the United Kingdom. What is the currency of United Kingdom? Pounds, right? Now, say for example, Amazon India has very little business in India, maybe 2 or 5%, but 95% of the business is based out of UK. Most of its operations are done for UK based customers. The payments also happen to a lot of UK based suppliers. The receipts are also coming from UK based customers. In India, it is just incorporated for whatever reasons, but large part of the operations, major part of the operations are based out of UK. Now, if UK economy impacts Amazon India, if UK is the primary economic environment in which Amazon India operates, then the functional currency of Amazon India is not INR, but it is GBP or pound. So, one thing that you need to understand is reporting currency will be determined by the country of incorporation. And generally, there is an assumption that the reporting currency itself is the functional currency. But it may be possible that the reporting currency is different from the functional currency, or the presentation currency in which the financial statements are presented, that is different from the functional currency. So, if UK is where Amazon India largely operates, then GBP becomes the functional currency, INR becomes the presentation currency. Then what is this foreign currency? Ind AS 21 says that the foreign currency is a currency other than the functional currency. So, say for example, we have US dollars, and Amazon India, whose functional currency is GBP, is transacting with its parent company or with some other customer in dollar terms. So, if this transaction is in dollar terms, then this dollar becomes the foreign currency. because GBP is the functional currency, because dollar is a currency other than the functional currency. So USD or the dollar becomes the foreign currency. So presentation currency, currency in which financial statements are prepared, functional currency, currency of the primary economic environment, and foreign currency, currency other than the functional currency. Why this additional introduction of functional currency? There are some impact at the time of translation and all of that. We will understand that when we reach that particular stage. For now, understand these three terms: presentation currency, functional currency, and foreign currency. In fact, I have worked in company, I have audited companies where the reporting currency is INR and the functional currency is USD, because purchases were designated in USD, purchases were based on United States dollar, and the sales were also based on USD, and most of the sales and purchase transactions were based out of USD or based on USD, and hence the functional currency was the US dollar, right? Now, as I told you, there is an impact of having this functional currency, in some translations and all of that. We will understand that when we reach that particular stage. So, let us have a look at this definition, pretty simple ones. Presentation currency is the currency in which financial statements are presented. Then, functional currency is the currency of the primary economic environment in which the entity operates, and foreign currency is a currency other than the functional currency of the entity. Now that we have understood those three terms, let us now understand what this standard deals with. Now, say for example, we have a company in India, say Amazon India, okay, this is registered in India, and for which we have said that the presentation currency is INR, and assume for a moment that functional currency is also INR, functional currency is also INR. Now, Amazon India also sells products to customers based out in US, okay, and say on a particular date, sale that was made was $1,000, sale that was made is $1,000. Now, you will not record this $1,000 as $1,000 in your Indian books, because you have to present the financial statements in INR. So, this $1,000 has to be converted into INR. Now, at what rate will we convert? We will convert using the exchange rate. Now, what is the exchange rate? Exchange rate is the rate at which you can exchange two currencies, to put it very simply. Okay, I know you have a very detailed chapter on currencies in your financial management. Now, when it comes to exchange rate, basically say you have $1. Against this $1, or to get this $1, how much of rupee do you need to pay? Say for example, I need to pay 85. Okay, so if I am paying 85 rupees to get $1, then the exchange rate between dollar and INR is 85. So, we present it as USD INR rate to be 85. This means what? This means what? Rupees 85 for $1. Okay, so to get $1 you need 85. Okay, now there are concepts around bid rate, ask rate, and all of that. Thankfully, we need not complicate our discussion in FR. Okay, that is a part of your financial management. So here what we are bothered about is an exchange rate. Okay, so exchange rate is 85. What does this mean? This is the dollar sale value. In INR, this will be 1000 multiplied by 85, which is 85,000. Okay. Now, you have recognized this transaction at 85,000 and you have sold something at 85,000. Assume for a moment money is received after 1 month. So, this is, let us say, day 0. Okay. On day 30, amount received from the customer. How much amount is received? We have received $1,000. Now, this is the day 0 rate, or I will put it here itself. Day 0 rate is 85, and assume for a moment on day 30 the rate becomes 84. So, you were supposed to receive $1,000, you have received $1,000, but when you receive this $1,000 and you convert at 84, ignore transaction charges and all of that, the amount that you will get is 1000 multiplied by 84, that is 84,000. Now, the standard talks about what should we do with the difference. What should we do with the difference? Now, for different kind of transactions, there are different treatments which you will be understanding. Here it is very simple. There is an exchange loss because you have to receive 85, you have received only 84. So, this is a loss. This loss will be taken to P&L. Okay, the same concept we would have learned in AS11 as well. So, this is one thing when we have a foreign currency transaction. So, the entity is entering into a foreign currency transaction, and when the transaction is actually settled at a later date, the amount that you realize would be different, and we will understand what should be the accounting treatment. And in some cases where the transaction is not yet settled, at the balance sheet date we will have to understand what do we do with the gain or losses which arises on restatement. Okay, that is the first part. So, this is the first part, which is a transaction. So, we will talk about foreign currency transaction, and then there is a concept called translation. Now, what is this translation? Say for example, we have Amazon US. And they have invested $100,000 in Amazon India. Now, as far as Amazon US is concerned, what would it say? Investment in subsidiary 100,000 multiplied by 85. Okay, so that comes to 85 lakhs. This is on day 0. Okay, now assume for a moment, while preparing the financial statement, that is on day 365, the exchange rate from 85 now becomes 87. Okay, so the exchange rate has moved up from 85 to 87. Now, in that case, what would happen? Let us have a look at. In that case, what will happen? Let us have a look at it. So, when Amazon US says investment in subsidiary 85 lakhs, what would Amazon India say? Share capital 85 lakhs and net assets 85 lakhs, a simple T form balance sheet. Okay. Now, on day 365, Amazon US has to incorporate the financials of Amazon India, and for that purpose, they have to do something called as translation. Why translation? Because this is in INR. Okay. Whereas, Amazon US has made an investment in subsidiary of $100,000. Okay. This is the equivalent INR, but in the balance sheet, this is what will be presented. $100,000 is what will be presented in the balance sheet, which is represented by net assets of 85 lakhs. Now, on this date, if you have to convert to USD, that is, on day 365, it comes to 85 lakhs divided by exchange rate of 87, that becomes 97,701. So, Amazon US invested these $1,000. No operations were carried out, no profit, no loss. We are just converting those net assets, and those net assets from $1,000 have come down to 97,701. Now, what should the entity do with such kind of exchange losses or exchange differences which arises at the time of translation? That is another thing which we will be understanding. So, we will be talking about how do we deal with foreign currency transactions. These are pretty simpler. Then we will talk about how do we handle foreign currency translation. Now, translation is not always with a holding company and a subsidiary company. It may be very well possible that one company in India has a branch outside India, okay, and we have to incorporate the branch trial balance into the company's accounts, and in that case we have to translate the trial balance. So, when we translate the trial balance, what happens to the exchange difference? That is what we need to understand, okay. And these exchange rates keep on fluctuating on a day-to-day basis, and if you look at over a long period of time, when I was doing my articleship, we used to close financial statements for dollar denominated items at around, I think, 45, 46. When I was working in a company, I used to close at 60 to 63. When I started teaching, it was 70, 75. Now, it touched 80. Very soon it will touch maybe 85, 90, 100, it keeps on depreciating, right? Because of the interest rate differential. So, this chapter you have to link with the foreign currency chapter that you will understand as a part of your financial management. Okay, so it's very important to link the subjects and understand. So, here we will be talking about how do we deal or how do we handle exchange difference on foreign currency transaction. Here we will be talking about realized, unrealized, restatement and all of those things. Then, how do we handle translation when you are translating a foreign currency trial balance and converting that into the presentation currency? How do we do that? So, that is the broad aspect of the standard, and exchange rate is the rate at which you will exchange one currency with another currency. Then you have some concepts like closing exchange rate, which is the spot exchange rate, at the end of the reporting period. Then we have something called as monetary items. We have already discussed about monetary items and non-monetary items, right? All those concepts we will put into practice in this particular standard. Now to decide what is the functional currency of an entity, the standard gives us some guidance. See, we cannot just randomly say that the functional currency of this company is this particular currency, because there has to be some logic based on which we need to decide what is the functional currency, right. So say for example, we are talking about a company which is incorporated in India, and hence the presentation currency. So we are talking about a case where presentation currency is the INR, okay. So it's some Indian company. Now what will decide the functional currency, that is the question. So for this, the standard gives us two broad set of criteria. One is the primary criteria, second is the secondary criteria. So primarily you have to look at these three aspects. What is the currency which influences the sales price of the goods and services? So say for example, I am a company in India, okay, and my sales price are influenced by USD, then my functional currency becomes USD. Now you may have a question, sir, how does USD influence my sale price? So let me give you an example. I was working in a commodity trading company. All the prices were determined based on the LME exchange rates which were quoted in US dollars. So the sales price of the commodities which were being sold were determined in USD terms. Even the customers would accept that. But will the customer pay us in USD or in INR? The customer will ultimately settle the account in INR only. But the sale price is determined based on USD. Okay, so there is one criteria based on which we can decide what is the functional currency. Second, what is the currency of the country whose competitive forces and regulations determine the sales price? Now what do I mean by that? Say for example, there is a company which is dealing in product where the large part of competition comes from some foreign country. So say the large part of competition comes from Korea. Okay. Almost 90-95% of the competitive forces are Korean competitors, and this product is also sold in Korea. Okay, I may be invoicing in INR, but the currency which is used to determine the price is the currency of Korea. So in that case, the functional currency will be the Korean currency. Similarly, what is the currency which influences cost? Now what is the meaning of this influencing cost? Let us say 95% of the raw material have to be USD based. So the cost of raw material are determined based on USD exchange rates, and 95% of the cost is let's say imports, and hence the currency which influences the cost will be USD, and USD will be the functional currency. Again, INR may be used to settle the transaction, to invoice the transaction, but what is the underlying currency which is determining my cost? So if you look at this primary aspect, what are we talking about? What is the currency which influences my sales price? What is the currency of the country whose competitive forces and regulations impact my sales price, impact my operations, and what is that currency which influences my cost? So considering these three criteria, you can decide what is the functional currency. Then the standard also says that you may also look into these additional two factors to understand which currency is the currency of the primary economic environment. The first one is funding. Say for example, we spoke about Amazon US, okay, and we have a wholly owned subsidiary Amazon India, right. Now if Amazon India is a wholly owned subsidiary and all the funding happens in USD, okay, and this could be one secondary criteria, it is not a primary criteria. Funding happens in USD and Amazon India operates in multiple different economies, multiple different countries, then because the primary source of funding, both maybe debt and equity, is US dollar terms, then the functional currency may be USD. And another one is currency in which receipts are retained. Say for example, there is a company which exports goods to other countries and get remittances in some foreign currency, but ultimately the currency in which the receipts are retained is INR, rest all operations are carried out in INR, then INR could be the functional currency. Okay. Now it is not a straightforward rule based on which you can decide, yes, this is the functional currency and this is not a functional currency. It has to be based on judgment. Sometimes there may be conflicting things, like let us say sale price are all USD driven, cost are all INR driven. Then what should be the functional currency? In that case you may consider, okay, currency in which receipts are retained is INR, then okay, I can say INR is the functional currency. Or if the receipts are also retained in USD, we have opened a dollar account and all the receipts are parked in USD account, then I can say the functional currency is USD. Okay. Now you have to consider different factors, all of these factors put together, and then you have to take a judgment as to what is the functional currency. And what is the functional currency? The currency of the primary economic environment in which the entity operates. It can be incorporated in any country, but which country's currency impacts the operations the most, that is what will be the functional currency. So, in a way to remember, you can see the currency of the country in which the entity functions, that is where the term functional currency appears to be, right. So, you can have a presentation currency in INR, this is for the preparation of financial statements. Then you can have functional currency, I gave you initial example of GBP, because this currency is what impacts the entity the most. This is the currency of the primary economic environment in which the entity operates, and then you have a foreign currency. Foreign currency may be something like a USD. So friends, we have understood that to determine the functional currency of an entity, we have to look at the primary indicators and also the secondary indicators. Now, say for example, we have a reporting entity in India. Let us say we are talking about IndigoLearn. Okay, IndigoLearn operates in India. We have courses which we offer for Indian students. Revenue is in INR, expenses are in INR. So, we can say that the functional currency of IndigoLearn is INR. What is the reporting currency? Reporting currency is also INR. Why? Because we are incorporated in India. Now, say for example, we started a branch in the United States. So, we have a separate entity IL US. Okay, this is a branch, right? So, this is a branch what we have started, and IL US, it operates in United States. Now, what would be normally the functional currency of this entity? For that, you have to again look at the primary indicators and secondary indicators, like what is the currency in which expenses are happening, income are being collected, right? What is the primary economic environment which impact this particular entity. Based on that, we will decide or we will conclude whether the functional currency is USD or something else. Say for example, we have determined that the functional currency of this is USD. Okay, this is a very simple and straightforward thing. Now, can there be a case that the functional currency of this foreign entity, that is our branch, is the same as functional currency of the Indian entity, that is INR? The question is, when can I say that this functional currency of the US branch is INR? Now, for that, the standard gives us some additional things to be checked. Now, what are the additional things to be checked? The first thing that you need to check is whether this US entity is just an extension of the reporting entity, which is IL. Meaning to say, though we have created an entity called ILUS, but now what this means is, though we have created an entity called ILUS, whether that entity is just an extension of the parent entity or the reporting entity, or it is an independent entity. Now, there could be two scenarios. Say for example, this particular entity ILUS, it sells only the courses which are offered by IL. So, basically, it is selling the courses which are offered by IL to the US students. Okay. And whatever amount is collected, that is remitted back to the Indian entity, that is IL. Okay, and all the expenses are again met by IL itself. So, the US entity is just acting as an extension of the reporting entity. Everything that this US entity does is dependent on this Indian entity. Okay, maybe some 5 to 10% is being handled independently, but the US entity largely depends on the Indian entity to carry out its operations. So, it is just acting as an extension of the Indian entity. In that case, the functional currency of this will also be INR. If it is acting independently, say for example, the US entity sells CPA courses, revenue is collected in dollars, faculties are hired there, it acts as an independent branch, then in that case, the functional currency will be USD. So, you have to check whether it is an extension of the reporting entity or it is an autonomous independent entity. So, if it is an extension, then functional currency will be equal to INR, which is functional currency of reporting entity. Okay. Now, if it is acting independently, if it is carrying out its operations independently, if it is handling students independently, it is not dependent on the reporting entity, then in that case you have to apply the primary and secondary indicators to decide what is the functional currency. So, under the first thing I will just summarize here. If it is extension, then functional currency is the functional currency of reporting entity. Okay. If it is autonomous or if it is independent, then you have to check separately. Then the US dollar can be the functional currency. Okay. Now, this concept is similar to what you would have learned, that is integral foreign operation and non-integral foreign operation. If it is an extension, it is an integral foreign operation. If it is autonomous or independent, it is non-integral foreign operation. Okay. Now, again, there are no hard and fast rules. You have to look at the facts and circumstances. There will be some degree of judgment that you need to apply to decide whether it is an integral one or a non-integral one. So, please note, Ind AS 21 does not use this term called integral operation and non-integral operation. What we need to see is, you have to look at this condition and accordingly decide what is the functional currency. Then, second thing that we need to check is, what is the volume or degree of transactions with reporting entity. What do I mean by this? We have to check what is the volume or what is the degree of transaction between this US entity and the Indian entity. Now, if you decide that this US entity has huge volume of transactions, a lot of transactions, significant portion of the transactions are done with the Indian entity or the parent entity, then in that case, the functional currency of the foreign entity will be the functional currency of the reporting entity. That is, a lot of purchases are happening from, let us say, the Indian entity. Then in that case, you may think that it is an integral part of the Indian entity and hence the functional currency could be INR. Okay. Then, so second thing is volume of transactions. If 90-95% of the transactions are done with the parent entity, then in that case you can say that the functional currency of the foreign entity will be the functional currency of the reporting entity. Then the third thing you have to check is whether the cash flow of foreign entity affects directly cash flow of reporting entity. Okay. So, in the third case, what you are checking? You are checking whether the cash flow of the foreign entity affects directly the cash flow of reporting entity and whether this can be remitted. So, if the foreign entity, whatever is the cash flow from operations of foreign entity that impacts the cash flow of the parent entity, then in that case we can consider that the functional currency of the foreign entity is the same as the functional currency of the reporting entity. Okay. Then, so this is the third thing you have to check is cash flow affects the reporting entity. Okay. And lastly, debt servicing. Now, in debt servicing, what you need to check is if there are any debt obligations of this US entity, okay, whether the US entity on its own can service the debt obligation without taking any help from the parent entity. If they can service their debt on their own without taking help from the Indian entity, then in that case we can say that it is autonomous, okay, and functional currency will have to be decided independently. But if to service the debt it is fully reliant on this Indian entity, then in that case we can say that it is just an extension of the Indian entity and hence the functional currency of that foreign entity will be the functional currency of the reporting entities. So, lastly we are talking about debt servicing. Debt servicing, okay. So, if the debt servicing is done independently, then it is not an extension. If it is not done independently, if it is dependent on the reporting entity, then it is like an extended operation and the functional currency of that entity will be the functional currency of the reporting entity. Now friends, here what are we trying to establish? We are trying to establish whether the foreign entity is independent one, it is a non-integral one, or it is integrated to the reporting entity. If it is integrated to reporting entity, then the functional currency would also be the same as reporting entity. So, as I gave you an example, if it is integrated, then INR will be the functional currency. Functional currency of what? Functional currency of this US entity. So, here what we can do is, if this ILUS acts as a integral part, then functional currency will be INR. If it is non-integral, then you have to decide independently, and most likely it will be USD, right? Now that we have understood what is a functional currency and how do we determine the functional currency, let us have a look at few questions and see whether we are in a position to determine the functional currency or not, right? So, let's have a look at a question. Future Limited sells a revitalizing energy drink that is sold throughout the world. Now, one more thing friends, don't get carried away by the name. Don't think that Future Limited means an Indian company unless the question tells that it's an Indian company or a US company. Don't get carried away by the name. Look at the question carefully and then decide the functional currency. Sometimes it may so happen that you are asked to determine the functional currency of a country which is incorporated outside India. Okay, it's not that you will only get Indian companies as the names, right? So, Future Limited, it sells a revitalizing energy drink, like some energy drink that is sold throughout the world. Sales of the energy drink comprise over 90% of the revenue of Future Limited. So, what is the major composition of sales? The energy drink. For convenience and consistency in pricing, sales of energy drink are denominated in USD. So, whatever are the sales that are happening, that happen in USD. The price that is printed on the product is also in USD. All financing activities of Future Limited are in its local currency, L dollar. It can be L dollar, it can be INR, it can be anything. So, here they are saying the local currency is L dollar and the sales are happening in USD. Although the company holds some USD cash reserves. Okay, so company also holds USD cash reserves. Almost all the costs incurred by Future Limited are denominated in L dollar. What is the functional currency of Future Limited? Now, here two things are given. One, USD is the currency in which sales are happening and L dollar is the one in which expenses are being incurred. Now, which one should we consider? Should we say USD is the functional currency or should we say L dollar is the functional currency? Before we jump into that conclusion, you read carefully here what is given. It is only for convenience and consistency in pricing, sales are denominated in USD and sales happen throughout the world. It is not that only it's happening in United States, it is happening throughout the world, but the pricing in dollar is only for convenience, okay, and expenses are in L dollar and they hold some USD cash reserves. It's not a significant portion. So, though there are some indicators that the company is dealing in USD, but because the sales are denominated only for consistency and convenience purpose. Now, because here sales price are denominated in USD only for convenience and consistency. Now, if you look at the primary indicators, what we learnt about, we talked about the currency which determines the sales price or the competitive forces or regulations of the country which have an impact of the sales price and the currency in which expenses are incurred. Now, here the sales price are denominated in USD only for convenience purpose. It is not that USD is impacting or it has a huge role in determining the sales price. Maybe they are calculating the sales price in local dollars and then converting into USD to print it on the package. And it does not, and the question says the drinks are sold throughout the world, not only in the United States, and the expenses are happening in the local currency. So, the functional currency of the entity will be the local currency and not the US dollars, right? So, sometimes when you have these kind of situations, you have to also use your judgment, okay? Just don't think that because all the sales will be in USD and hence USD will be the functional currency. No, nothing like that. Is USD determining the sales price? No, the sales price is converted to USD for convenience purpose, right? Hence, the local currency or the L dollar will be the functional currency. Let's look at another question. Small India Private Limited, a subsidiary of Big Ink. Okay, so Small India, looks like an Indian company. Big Ink looks like a US company. Takes orders from Indian customers for Big Ink's merchandise and then bills and collects for the sale of the merchandise in rupees. Okay, so the company takes orders from what? The company takes order from Indian customers. Okay, for whose merchandise? For Big Ink's merchandise. So now here it looks like an extension. Let's read on. Small also has a local warehouse in India to facilitate timely delivery and ensure that it remits to its parent cash flow that it generates, as the operations of Small are primarily influenced primarily financed by Big Inc. Big Inc is based out of US and has a functional currency as USD. What is Small's functional currency? Now, Small is operating in India. Okay, Small is operating in India. It has warehouses in India, but where is it buying the material from, or where is it sourcing the material from? It is sourcing the merchandise from Big Inc. That is one thing. Then whatever is the cash flow that is collected, it is being remitted to Big Inc. Big Inc is financing the operations of Small Inc. So whenever we are looking at a foreign operations, we spoke about those additional factors to be checked, right? Now, if you look at those additional factors, that is the volume of transactions. What is the volume of transactions with Big Inc? Almost all, the entire purchases are happening from Big Inc. Then the financing is done by Big Inc. The cash flows are remitted back to Big Inc. So what we can say is Small Inc. is an extension of Big Inc. or Small Inc. is an integral part of Big Inc. Now, because Small Inc. is integral part of Big Inc., we can conclude that the functional currency of Small will be the same as the functional currency of Big, which means the functional currency of Small will also be USD. Now, you might have a doubt, sir, are we not selling those material in India? Yes, we are selling those material in India. Then shouldn't the functional currency be INR? Now, whenever we are looking at a foreign operation or a foreign entity, we have to check additional factors. And if those additional factors indicate that the foreign operation or foreign entity is more like an extension of the reporting entity, here which is the Big Inc., then the functional currency of the foreign entity or the foreign operation will be the same as the functional currency of the reporting entities. So here, if you look at the functional currency of Big Inc., it is USD. Big Inc. is financing, it says clearly, see, operations of Small are financed by Big Inc. Then Small Inc. also purchases all the merchandise from Big Inc. and it takes orders only for Big Inc.'s merchandise, and it remits all the currency back to Big Inc. The only thing is transactions happen in INR. Okay, now INR is not the currency which is determining the sales price, because you are importing and based on the import pricing itself you will decide what is the price at which you will sell to the customers, right? So Small Inc. here is acting as an extension, an extension of the main company or the Big Inc., and hence the functional currency of Small will also be USD and not INR. One thing that you would have understood by now is just because sales happen in INR does not make the functional currency INR, okay? Because most of the things are dependent on USD, you will consider the functional currency to be USD. Let's have a look at another question. A is an Oman based company having a foreign operation B in India. Okay, so we are looking from the point of view of Oman based company which has a foreign operation in India. So for a company based out of Oman, there is an operation in India which is a foreign operation. Okay, the foreign operation was primarily set up to execute a construction project in India. The foreign operation was primarily set up to execute a construction project in India. So there is some construction project in India and this company is executing that. The functional currency of A is OMR. So for this company, which is the Oman based company, what is the functional currency? OMR. 78% of entities B finances have been raised in USD by way of contribution from A. Okay, so 70% of entities B, where is entity B? Entity B is in India. The finance has been raised in USD by way of contribution from A. B's bank accounts are maintained in USD as well as INR. So B has both US accounts as well as INR accounts. Cash flows generated by B are transferred to A on a monthly basis in USD in respect of repayment of finance received from A. So whatever is the cash flow that this entity B generates, it is being given back to A as a repayment of the finance, and the repayment is happening in USD. Revenues of B are in USD, its competitors are globally based. So revenue is in USD, competition is global. Tendering for the construction project happened in USD. B incurs 70% of the cost in INR and remaining 30% of the cost in USD. Since B is located in India, can it presume its functional currency to be INR? Now, the question is, can B presume that its functional currency is INR? Now, if you look at the entire history or entire transaction details that is given, INR is nowhere in picture. Apart from the 70% of the cost, sales are happening in USD. Finance is being obtained in USD, 30% of the costs are incurred in USD, the finance being repaid back is happening in USD. So, for sure we cannot presume that INR should be the functional currency just because this company is operating in India, it is incorporated in India, we cannot say or we cannot presume that INR will be the functional currency. Okay, why? Because of these factors, like INR cost is only 70%, your revenues are fully in USD, bidding has happened in USD, financing is in USD, 30% of the cost is in USD, there are some bank accounts maintained in USD. So INR cannot be the functional currency. Then what can be the functional currency? Now functional currency can be either the functional currency of this Oman company, which is OMR, or it can be USD. Now for a foreign operation, we have to check for those additional factors. The first factor that we need to check is it an extension of the Oman based entity? It does not look like an extension, it is functioning independently, right? Second, whether the transactions with the Oman entity, is it high or low? So here there are hardly any transactions with the Oman based entity. It is carrying out a construction project in India. The only transaction with the parent entity is financing and repayment of those finances. Then the next thing that we have to check is, can this entity on its own manage its debt obligation? So here we can see the cash flows which are generated by B are being sent back to A, and that is more for repayment of the finances that was raised. So we can say this company on its own is able to manage its finances or manage its debt obligation, right? Then does the cash flow of B directly impact the cash flow of A? See, indirectly it is impacting. Directly the cash flow from operations, say for example cash flow from sales, is not impacting the cash flow of the parent entity. The cash flow is being impacted only to the extent of repayment of debt. So the additional conditions clearly indicate that the functional currency of entity B cannot be OMR. It cannot be the functional currency of the parent entity. That is the first thing. Then what will be the functional currency? If you look at the facts and circumstances, sales are 100% in USD. Financing is in USD, 78% of the financing is in USD. Then 30% of the cost is in USD, and there are accounts maintained in USD. The tendering was done in USD. So considering all of these circumstances, which are the primary and secondary indicators, we can conclude that the functional currency of this entity is USD. So it is not INR, it is not also OMR, right? So to check whether it is OMR or not, we have to look at those 4 additional conditions. To check whether it is INR or not, we have to look at primary and secondary conditions. So looking at the primary and secondary condition, we can say that this entity's functional currency is not INR, it is not OMR, it is USD. Moving on, S Limited is a company based out of India which got listed on Bombay Stock Exchange in the financial year ended 31st March of year 1. Since then, the company's operations have increased considerably. The company was engaged in the business of trading of motorcycles. The company only deals in imported motorcycles. These motorcycles are imported from US. Okay, so Indian company listed in India, imports motorcycles and sells those motorcycles. After importing the motorcycles, these are sold across India through its various distribution channels. The company had only private customers earlier, but the company also started corporate tie-up and increased its customer base to corporates also. The purchase of the motorcycles are in USD because the vendors from whom the motorcycles are purchased are in US. All other operating expenses of the company are incurred in India only because of its location, and they generally happen to be in INR. Currently, its customers are both corporate and private in the ratio of 70 and 30. The USD denominated prices of motorcycles in India are different from those in other countries. So, the price that is denominated in India is different from the price in other countries. Meaning to say, if you are buying the motorcycle in India, even if you quote them in USD, that price is different as compared to the prices which are quoted in other countries. The company is also expecting that in the coming years, its customer base will increase significantly in India and the current proportion may also change. Currently, invoices are raised to the corporate customers in USD for the purpose of hedging. However, private customers don't accept the same and hence invoices are in INR. What would be the functional currency of this company? Now, to determine the functional currency, we again have to look at the primary indicators and the secondary indicators if required. Here we are not looking at any foreign operation, so additional conditions are not required to be checked. Okay. Now, coming to the primary and the secondary indicators, what do they talk about? They talk about what is the currency that impacts the sales, or which country's competitive environment, which country's regulations impact the sales. Now, if you read the question, you will feel that it is USD which is impacting the selling price. But here if you see, the USD denominated prices of the motorcycle in India are different from those in other countries. Now what does this indicate? The Indian economic environment, the competition in India is determining the sales price. So this is one indicator that the primary economic environment will be India. That is first thing. Then second, if you see, not all the sales are happening in USD. So here if you see, corporate is 70 and 30 is retail. So 30% of the sales are again transacted in INR. For others it is being transacted in USD, and for others it is being invoiced in USD, and that invoicing in USD is more for hedging purpose, because you are importing in USD and you are billing in USD to ensure that there is some kind of natural hedging which is available. If you see, the operating expenses are incurred in INR, the USD prices in India are different from the USD stated prices across the globe. So it is the Indian economic environment which is impacting the operations of this company. The customers are also based out of India. The only thing that is dependent on USD as a currency is the import of the products, and because we are importing, we will have to pay in USD. But a larger part of the operations, the sales are being impacted by the Indian economic environment, and hence we can conclude that the functional currency is INR, right. So here in this case again, what you have to check is the primary indicators, the secondary indicators. You don't need to check for the additional conditions for foreign operations. Based on the primary and secondary indicators, we can conclude that here the functional currency is INR. So one more thing that you would have understood by now is that just because a company is importing from a foreign country and paying for those imports in USD does not make USD the functional currency, okay, because see, there will be a lot of import transactions for a lot of companies. That does not make USD the functional currency. You have to check whether USD is impacting my sales, whether the United States economic environment, the competitive landscape is determining my sales and my operations, right. Is the company entering into all the transactions in the USD, and United States is the primary economic environment which impacts the operations of the company. You have to look at all of these factors and then decide whether the USD will be the functional currency or INR will be the functional currency. In a lot of cases, it may not be very easy to decide whether it is USD or the reporting currency. So that is where the judgment of the management comes into picture. So as I was telling you, I worked in companies where USD was the functional currency just because the imports were impacted by USD prices, the sales were also happening in USD. Almost 95 to 98% of the transactions were denominated in USD or were impacted by USD. Billing may happen in INR, but the underlying pricing was decided based on USD, and hence the functional currency was USD. Okay, so you have to look at primary indicator, secondary indicators and additional factors to decide what is the functional currency. So now we have seen some theory questions. Let us quickly have a look at how should we present those questions in the examination, and especially if it is a case based question, you have to explain what the standard says, what is the fact of the case, and how do you link the fact with the provisions in the standard, and what is the conclusion. So whenever you are talking about determining the functional currency, the first thing you have to look at is the primary and the secondary indicators, right. So you have to look at primary and the secondary indicators. Should we need to look at the additional conditions? We should not look at them. We are not required to look at them, because this is not the question on determining the functional currency of a foreign operation, right. So that is the first thing. So what are primary indicators? Primary indicators is basically the currency that mainly influences the sales price for its goods and services, and the currency of the country whose competitive forces and regulations mainly determine the sales price of its goods and services. Now here the sales price is denominated in the US, but which is the country whose competitive forces determine the sales price? It is India, because the question says the sales price in India is different from sales price across the globe. So this indicates that Indian economic environment is the primary economic environment, and also the labor, material and other cost of providing goods and services, the currency which mainly influences. Now here, as far as imports are concerned, it is impacted by USD. As far as the local operations are concerned, again INR has an impact. Okay. Then secondary indicators, if at all we are not able to determine using the primary indicators, secondary indicators are the currency in which the funds from financing activities are generated. That is first thing, and the currency in which receipts and operating activities are usually retained, right. Now here billing is in USD, but the retention is in USD and also in INR, right. That is what the question says, right. Then the second one is the currency in which the receipts from operating activities are usually retained. So here billing is done in USD for hedging purposes. For retail customers, billing is done in INR, right? And if you look at the question, it also says that the company is expecting that in coming years its customer base will increase significantly in India. Okay, and moving further, Ind AS 21 gives greater emphasis on the currency of the economy that determines the pricing of the transaction as opposed to the currency in which transactions are denominated. So, two things that you need to understand here is which is the currency in which transactions are denominated. Here largely it is USD, but which is the economy that determines the pricing? It is the Indian economy. So, you have to consider the currency of India as the functional currency. So, sales price of motorcycles are mainly influenced by the competitive forces and regulations in India. The market for motorcycle depends on the economic situation in India, and the company is in competition with importers of other motorcycle brands. So, it is in competition. Even though 70% of the revenue is denominated in USD, Indian economic conditions are main factors affecting the prices. This is evidenced by the fact that USD denominated sales price are different from USD denominated sale prices for the same motorcycles in other countries. So, on the basis of above analysis, INR should be considered to be the functional currency of the company. So, this is how you should present your answer. If at all it is a question on foreign operations, then you have to include those 4 additional factors as well. Now that we have understood the meaning of functional currency in detail, let us move on to the core part of the standard that deals with initial recognition of a foreign currency transaction and subsequent measurement of a foreign currency transaction. Now, before that, we also need to understand what is this foreign currency transaction. Now, as far as the foreign currency transaction is concerned, if an entity enters into a transaction which is denominated in foreign currency or which requires settlement in foreign currency, it is called a foreign currency transaction. So, there are two aspects. The transaction must be denominated in foreign currency. So, say for example, functional currency is INR, foreign currency is USD. Now, if an entity enters into a transaction in foreign which is denominated in foreign currency, say for example, buying and selling of goods and the invoice is given in USD, then in that case it is a foreign currency transaction. Or the entity borrows money or lends money which is in the foreign currency, then also it's a foreign currency transaction. Or the entity acquires asset or disposes of assets or incurs a liability or settles a liability and the transaction is denominated in USD, then it is a foreign currency transaction. So, if the transaction is denominated, meaning to say you are entering into a transaction which is denominated in foreign currency. So, the entity buys or sells goods where the transaction is denominated in foreign currency, that is invoice may be in the foreign currency, or the entity borrows foreign currency loan, or the entity lends money in foreign currency, or the entity acquires any other assets or incurs any other liabilities where the transaction is denominated in foreign currency, then it is called a foreign currency transaction. So, the thing that you have to check is what is the currency in which the transaction is denominated. The other thing talks about settlement of the transaction in foreign currency. Now, that is the case where the transaction may be entered into in INR, but settlement will happen in USD. Even in that case, it is called a foreign currency transaction. So, maybe the invoice given is in INR, but settlement has to be done in USD. So, even in that case, it is called a foreign currency transaction. So, we have understood the meaning of a foreign currency transaction. Let us understand how should we initially record a foreign currency transaction, that is what is the initial recognition principle and how should we subsequently measure the foreign currency transaction. Okay. Now, subsequent measurement can be at the end of the reporting period or it can be at the time of settlement of the transaction, right. First, we will talk about how do we initially measure a foreign currency transaction. First thing, what is foreign currency? It is a currency other than functional currency. Okay. So, first thing what we need to do is we need to determine the functional currency. Okay. Say for example, functional currency is INR. I am just giving an example. Functional currency is in INR. Then say we have a company Infosys. Okay. Infosys exports what? Services, and the transaction is denominated in USD. And the transaction is USD denominated. Okay. So, say for example, Infosys exported services worth $10,000. Okay. $10,000 is the value of export. Now, here Functional currency is INR. So USD becomes what? USD becomes foreign currency. Okay. And because the transaction is denominated in a foreign currency, it's a foreign currency transaction. Now, as far as initial recognition is concerned, you have already understood that as a part of AS11 as well. A foreign currency transaction is initially recorded in the functional currency applying the exchange rate prevailing on that day. What is this exchange rate? Exchange rate is the rate at which you can exchange two currencies. So, say for example, 1 USD is INR 90. Okay, 1 USD is INR 90. This is the exchange rate. So, what the standard says is, if it is a foreign currency transaction, you have to record the foreign currency transaction in the functional currency. Now, can it be possible for some companies that even the reporting currency is a foreign currency? Yes, it is possible. The transactions have to be recorded in functional currency only. So, what is the functional currency? INR. You have to record this transaction in INR. So, on the date of transaction, say it is 1st of January of year 1, okay, you will record the transaction as debit receivables for the customer. By what amount? You will say $10,000, that is the foreign currency, multiplied by the exchange rate prevailing on that date, 90. So, 9 lakhs is the debit to the receivable or the customer, and you will credit revenue or sales, whatever the case may be, by 9 lakhs. Okay, you will debit the customer by 9 lakhs and you will credit the revenue or sales by 9 lakhs. So, you will record a foreign currency transaction only in the functional currency. So, sometimes it may be possible that, just for argument's sake, okay, the functional currency of this company is GBP, just for example, okay, and a transaction happens in INR. Now, this transaction in INR is also a foreign currency transaction which you have to record in GBP. Okay, that is one thing you have to understand. All the transactions will be recorded in the functional currency only. So, what if the presentation currency is different? If the presentation currency is different, we will have to convert these transactions for presentation purpose, but recording of the transactions will happen only and only in the functional currency. If there are any other transaction other than in functional currency, you have to convert them into functional currency and record those transactions. So, initial recognition happens at the exchange rate prevailing on that date. Now, exchange rate keeps on fluctuating, right? Even on us, even after every second, the exchange rate would fluctuate. So, for that purpose, an entity may use an average rate for the day, average rate for the week, average rate for the month, if at all the fluctuations are not very high. But if there are very high fluctuations, then average rate may not be appropriate. Okay. Now, in most of the cases, what companies do is they use something called as a reference rate. Okay. Earlier, the reference rate was published by RBI. Now, reference rate is published by an association. You can look at the reference rate for the day, and at that rate, you can record the transaction. Or you can take the real-time quote and then record the transaction. That makes it very complex, especially when you have thousands and thousands of transactions. Some companies may choose to use the closing rate, some companies may choose to use the average rate. It depends on the policy of the company. Okay. Now, after you have recorded this transaction, this is what is called initial recognition, and I am repeating once again, initial recognition is always at functional currency. Why am I repeating this? Because it may be possible that reporting is in INR, for example, functional is USD and transaction is in GBP. Okay. Now, is this transaction a foreign currency transaction? Yes. In which currency will you record this foreign currency transaction? Don't say that we will record this foreign currency transaction in INR. You will not do that. You will record this foreign currency transaction in USD. Even if you get some transaction in INR, even that has to be recorded in USD only. So, all the transactions will be recorded in USD. Okay. Now, sir, but balance sheet has to be presented in INR. Later on, you will convert all of this USD transaction and present them in INR. We will understand that subsequently. Okay. That is as far as initial recording is concerned or initial recognition is concerned. Now, subsequently, moving on to the subsequent measurement. Now, say for example, this customer paid on 31st of March of year 1, okay, that is the date on which he paid, and we received $10,000. and when we converted them, we could convert them at 88 only, okay, because that is the rate applicable on that date. So, on that date, how much have you received? You have received 88 multiplied by 10,000. So, amount received is 88 multiplied by 10,000, which is 8,80,000. Amount receivable was 9 lakhs. So, because you have received less, there is a foreign exchange loss. So, the foreign exchange loss will be 9 lakhs minus 8,80,000, 20,000. This will be recognized in P&L. So, the entry that you will pass is bank account debit 8,80,000, foreign exchange loss 20,000, and to receivable 9 lakhs. Okay, this is when you settle the transaction. This is when the settlement happens, you will recognize the foreign exchange gain or foreign exchange loss. Now, this was the case where the transaction is actually settled. Okay, so in that case, we recognize the gain or loss on the settlement of the transaction. But what if the transaction was not settled and this transaction was outstanding as on the reporting date? How should we measure the transaction? So, for this, what the standard does is, it classifies assets and liabilities into monetary items and non-monetary items. So, what you need to check is whether the item is monetary or non-monetary. Okay. So, depending on whether the asset or liability is a monetary item or non-monetary item, the subsequent measurement is done. In case if it is a monetary item, then subsequent measurement will be done using the closing rate. Now, what is the meaning of closing rate? So, what you need to do is, if the amount is still outstanding, if the transaction is not yet settled, and if it is related to a monetary item, then you will have to remeasure the monetary item using the closing rate at the end of the reporting period. So, for example, in that particular case, the transaction was not actually settled. The transaction was not yet settled on 31st of March of year 1. Okay, exchange rate is 88. So, you will have to remeasure the monetary item or subsequently measure the monetary item using the closing rate. So, receivable is $10,000, closing rate is 88. So, closing balance will be 10,000 multiplied by 88, which is 8,80,000. Now, what are these monetary items and non-monetary items? We already have understood these in our earlier standards. Just to recap it, monetary items are those assets and liabilities whose amount is determined or whose amount is fixed, and you for sure know the amount that you will realize when you dispose the asset or the amount that you have to pay when you settle the liability. For example, accounts receivable. Now, in this case, we for sure know that we will receive $10,000 from our customer. So, monetary items could be things like sundry debtors, or you also call them account receivables, right? Then it could be your cash and cash equivalents. Okay, these are also monetary items because you know you have so much of amount in your bank account. So, those are also monetary items. Things like fixed deposits, these are also monetary items. Okay, then you have creditors, loans. All of these are monetary items because you know the amount that you will have to pay to settle the liability or the amount that you will realize when you realize that particular asset. So, these are monetary items. Now, you may have a doubt, sir, in this case, though it is $10,000, we don't know what is the exact INR amounts. Then how is it a monetary item? It is a monetary item because we know that we will collect $10,000 from our customer. Sir, what if the customer goes bankrupt? That is a different aspect. But on the balance sheet date, I know that this customer has to pay me $10,000 and hence it is a monetary item. Then what are non-monetary items? The non-monetary items are those items whose amounts are not determined. Say for example, inventory. As far as inventory is concerned, though we put some value on the balance sheet date, do we actually know what is the amount we will realize when we sell off that inventory? We do not know. But sir, we do this valuation like lower of cost and NRV. Yes, we do that valuation, but do we know at what value will we sell that inventory? We do not know. So, the inventory is a non-monetary item. Similarly, fixed assets is a non-monetary item. Your equity is a non-monetary item. Investments are non-monetary item. Investments in especially your shares, okay, these are non-monetary items, right? So there are items of assets and liabilities where we do not know what is the value that we will realize or what will be the amount that is required to settle the liability. Such items are called non-monetary items. So what the standard says is, if at all there is a monetary item, in this case we are talking about sundry debtors, you will measure the monetary items at the end of the reporting period at the closing rate. Okay. Then what about non-monetary item? Non-monetary items are divided into two categories. Okay. One, non-monetary items at historical cost, and second, non-monetary items at fair value. If some item is designated as non-monetary item at historical cost, then you will use historical rate. For example, if you are measuring a property, plant and equipment item, property, plant and equipment, you are following the cost model. So you will measure the property, plant and equipment at historical cost. So the exchange rate should also be historical cost. Now what is that fair value? Say you are measuring the property, plant and equipment using the revaluation model. So you are doing a fair valuation. So in that case you will take rate on fair value date. Rate on fair value date. So whenever you are doing the fair valuation, you will use the exchange rate on the date on which you have done the fair valuation. So subsequent measurement is pretty simple. If it is a monetary item, you will consider the closing rate. If it is a non-monetary item, you will consider the historical rate. If the non-monetary item is at fair value, you will consider the rate on which you have done the fair valuation. So here in this case, in our example, because the closing balance is 8,80,000, okay, now the receivable initial recognition was at 9 lakh and subsequent recognition is at 8,80,000. So there is a loss of 20,000. So how do you record the transaction? Foreign exchange loss 20,000 debit and receivables 20,000 credit. So I'll write it here. So after this entry, receivables would be shown at 8,80,000 on the balance sheet. So let's quickly summarize whatever we have learned so far. As far as foreign currency transactions are concerned, these are the transactions which are in foreign currency. And what is the foreign currency? A currency other than the functional currency. Okay. As far as initial recognition is concerned, a foreign currency transaction shall be recorded as per the standard on initial recognition in the functional currency. So please keep this thing in mind. The transactions will be recorded in functional currency. It may be possible that the presentation currency is in INR, but the functional currency is say GBP, then you will record those transactions in GBP. So then how will we present those financial statements in INR? Then we have to do a translation. Okay. You will recognize it in functional currency by applying to the foreign currency amount the spot exchange rate between the functional currency and the foreign currency on the date of the transaction. So you will take the spot exchange rate just because you are expecting to realize debtors after 3 months or 6 months, you will not take the future rates. Okay. You will take the spot exchange rate at the date of transaction, and we have seen that an average rate can also be taken. But if the currency is highly volatile, you cannot take the average rate, right? That is as far as initial recognition is concerned. Now coming to subsequent measurement, if the items are monetary items like cash and cash equivalents, debtors, sundry creditors, loans payable, these are measured subsequently considering the closing rate at the reporting date. So on the reporting date, whatever is the closing rate, you will apply the closing rate and measure these monetary items. And as far as non-monetary items are concerned, if they are measured at historical cost, so say for example, there are fixed assets denominated in foreign currency. Now when would that be possible? Say there is a branch which is a foreign branch. Say there is a foreign branch. Okay. Now this foreign branch had purchased certain items of PPE and it was purchased at, let us say, $10,000. Okay. Now property, plant and equipment can be measured using historical cost or it can be measured using revaluation model. So if say it is measured using historical cost, now as far as the measurement model is concerned, you have to look at Ind AS 16. Ind AS 21 does not tell you how to measure. Ind AS 21 only tells you if there is a foreign currency transaction or if there is an item denominated in foreign currency, how should you convert that into the functional currency. Okay. So say historical cost, we are following historical cost, and on this date exchange rate is say 85. Okay. So what is the historical cost? 10,000 multiplied by 85, 8,50,000. So you will measure it as 8,50,000 INR, and you will continue to measure this item as at 8,50,000. Okay. That is when you follow the historical cost. If you follow the revaluation model, and after revaluation, let us say the revalued amount is 11,000. Okay. And exchange rate on date of revaluation is say 83 or 82, say 83, then you will measure it as 11,000 multiplied by 83, which is 9,13,000. So whenever you are following the revaluation approach, the date on which you determine the revaluation or the revalued amount or the fair value, consider the exchange rate of that particular date and arrive at the functional currency amount. Okay. Just because you have done the revaluation does not mean you will use the original transaction date rate. So if you are following historical cost, what was the rate applicable to that transaction on the transaction date? So spot exchange rate at the transaction date will be considered to measure those items which are measured using historical cost. If you are following fair value approach for some of the items, you will follow the rate on which the fair value was determined. Now sometimes what happens is we have items like inventory. Okay. Items like inventory. Inventory is a monetary item or non-monetary item? It is a non-monetary item. Okay. Now non-monetary items means if you are measuring it at historical cost, you have to take the historical rate. If you are measuring it at NRV, you have to take the NRV rate. So say for example, purchased or cost is again $20,000 for example. Transaction date, exchange rate is 85 and end of reporting period exchange rate is say 82. Okay. Now this particular item of inventory has an NRV $20,500. Okay, that is the net realizable value. Now in dollar terms, you will value inventory at cost. You will say cost and NRV, whichever is lower. Because the cost is lower, you will value it as cost. Now coming to INR financials, coming to INR, when you translate it, what is the cost? When you find out cost in INR, what is the exchange rate? Exchange rate is 85. So the cost comes to 20,000 multiplied by 85, 17 lakhs. What is the NRV? NRV is at 82 because that is end of the reporting period, and 2500 multiplied by 82, it is 1681. So net realizable value in INR is less than the cost. So how will you value the inventory? You will value the inventory at net realizable value, which is 16,81,000. So though in dollar terms there is no loss related to impairment of inventory, in INR terms you can see that from 17 lakhs it has come down to 16,81,000, and you will have to recognize the loss because there is a fall in the value of inventory due to the fluctuating exchange rate. Okay. So even though in the foreign currency there is no loss, in the functional currency there can be a loss because cost is higher than the NRV. So when you are determining the cost, take the exchange rate on the date of transaction. For NRV, take the exchange rate on the date of NRV and compare both of them, and you have to take the lower of the two. Lower of the two is as per what? As per Ind AS 2. Right? As per Ind AS 2, you will value it at 16,81,000. So if the non-monetary items are measured at historical cost, you will take the exchange rate at the date of the transaction. If it is at fair value inventory, then revaluation of property, plant and equipment, then impairment of assets where you have this fair value concepts. Whenever you are using fair value, you will take the exchange rate on the date on which fair value was arrived. I hope it is absolutely clear. How do we measure the monetary items and how do we measure the non-monetary items? Now we have understood how to initially recognize the transactions and how to subsequently measure the transactions. Now the next question that we need to answer is that what do we do with these exchange differences? And friends, let me tell you, you have already learned about this largely under AS11. There are some minor differences what you need to handle here because of this functional currency and presentation currency thing. Otherwise, by and large the concepts are similar, right. So first let us see what happens to monetary items. Monetary items. So let's take an example, say we have Infosys. Say we have Infosys and the functional currency is INR. Infosys does some exports. Let's say there is a US based company and this invoicing is done in USD and let's say that is $1,000 and exchange rate on the date of transaction is say 80. I have taken 80 for simplicity in calculation, okay. Now this US company say has 3 months to pay the amount back to the Indian company. Now few things that we have already understood. Infosys will record this particular transaction in which currency? Functional currency. So sales will be booked at 80 multiplied by 1000, 80,000, okay. Now let us say 3 months, so just let's take different dates. Let us say we are on 1st of March of year 1 and after 3 months, that is on 1st of June of year 1, that is when the payment happens, and on this date the exchange rate is say 85, okay. So Infosys will book revenue at 80,000 and Infosys has something called account receivable which is also at 80,000. Now is this a monetary item or a non-monetary item? This is a monetary item which is equivalent to $1,000. Now what the standard says is, this monetary item of $1,000, because it is not settled, see if it is settled then whatever is the difference that we get, that will be our gain or loss, okay. Because it is not settled as on 31st of March, you have to remeasure them and say on 31st March, exchange rate is at 82. So on 31st of March, you have to remeasure this particular account receivable. So what you will do is, account receivable is equal to 1000 multiplied by 82, that is 82,000. Initial recognition is at 80,000. This 2000 is your gain, okay. I am purposely going slow because you need to understand the flow of transaction. After that you will be masters in doing this. So this 2000 of exchange gain, what the standard says is, this 2000 of exchange gain that has arisen because of remeasurement of a monetary item, this has to be taken to, you guessed it right, P&L. So whenever there is a monetary item, if at all there is any gain or any loss on remeasurement, you will take it to P&L. So then what will you do in case of settlement? In case of settlement also you will take it to P&L. So I told you settlement happened at 85. So how much amount did you get? 85,000 is the amount received, right? 85,000 is the amount received. So when you come here on, let us say 1st of June, amount received is 85,000. Now don't tell that 85,000 minus 80,000, 5,000 is gain. 5,000 is not gain. This 85,000 you have to compare with this 82,000. So gain here is equal to 85,000 minus 82,000, that is 3,000. What will we do with this gain? This gain will also be taken to the P&L. Okay, so whatever is the gain on remeasurement of monetary items denominated in foreign currency, the gain will be taken to P&L. Sir, what in case subsequently there is a loss? What if the exchange rate instead of 85, say the exchange rate is 81, then 81,000 received minus 82,000 is the carrying amount, this minus 1,000 the loss, this will also be taken to P&L. So one thing that is clear is the exchange differences arising out of monetary items will be taken to P&L. That is the first rule which you need to remember. Now coming to exchange differences on non-monetary items. So we discussed about monetary, now we are talking about non-monetary. Where do we take these? What the standard says is a very simple principle. That is, if the gain or loss on this non-monetary item is taken to OCI, then exchange differences also should be taken to OCI. So, if this gain or loss is recognized in OCI, then exchange difference should also be recognized in OCI. What do I mean by that? Say for example, this non-monetary item is an item of property, plant and equipment under revaluation model. Now, as per Ind AS 16, what do we do with the revaluation surplus? That revaluation surplus is taken to OCI. So, the standard says, if at all the revaluation surplus is being taken to OCI, then any exchange difference arising on such items should also be recognized in OCI. Okay. The other part, if the non-monetary item, the gain or loss on the non-monetary item is recognized in P&L, then the exchange difference will also be recognized in P&L. A very simple principle. So, say for example, there is an impairment loss. Where do you recognize impairment loss? Sir, in P&L. So, exchange differences on such items will also be recognized in the P&L. So, when I am saying impairment of an asset, if there is a non-monetary item which is being impaired, a simple example could be inventory. If inventory is being impaired, where do you recognize the loss on impairment of inventory, that is reduction in value of inventory? You will recognize it as a part in the P&L. So, what the standard says is, even the exchange differences on such items, please recognize in P&L. So, a very simple principle for non-monetary items. Now, there is one more item which is called NIFO, net investment in foreign operation. This will cover separately. I don't want you to be confused right now. Okay, let us handle the easier things first, then the difficult ones we'll handle it separately once we are comfortable with the balance standards. So, the principle, monetary item P&L, non-monetary item, if the gain or loss on that non-monetary item is recognized in OCI, you will take it to OCI. If it is recognized in P&L, you will take it to P&L. It is like where you recognize the main component, the exchange difference also will be recognized there itself. Now, as far as these exchange differences are concerned, few things that we have to keep in mind is, if the exchange difference arises out of an item which qualifies for hedge accounting under Ind AS 109. Now, sir, what is this hedge accounting? What is Ind AS 109? That you will understand as a part of financial instrument. The thing that you have to remember now is, if it is something which is covered by 109 under hedge accounting, then the treatment given under Ind AS 21 will not apply. So, to this, whatever treatment we understood above, that is Ind AS 21 will not apply. That is one thing you have to keep in mind. Now, what is this hedge accounting? See, sometimes what happens is, there may be a cash flow in future. Okay, there may be in future we will import something, and related to import there may be some cash outflow. For that, the company may enter into some derivative transactions. Okay, and these derivatives qualify as hedges. Okay, so there is effective portion, ineffective portion and all of that. Don't worry about that. Just think of it that there is a future cash flow for which we have entered into some derivative transaction because we want to safeguard our position. Say I have to pay $10,000 after 1 year. So, I have entered into a corresponding future transaction to hedge my cash flow. Now, if the hedge is effective, the gain or loss has to be taken to OCI and all of that, that is what is the accounting treatment. But as far as these items are considered, there may be a foreign currency item or a foreign currency transaction in derivatives. We have entered into a foreign currency future contract, right? Now, such contracts, if they qualify for hedge accounting, then in that case, the treatment given under Ind AS 21 will not apply. So, then how will we deal with it? We will deal with it as per the provisions or as per the guidance given under Ind AS 109. That is the first thing. Second thing is, I don't know how many of you remember, there is something called as paragraph 46A in Accounting Standard 11, which deals with what? Which deals with FCMITTA. You can pause the video and think of the full form. You have learned this as a part of Accounting Standard 11 and don't forget that, okay. Just because you are learning Ind AS does not mean that you will forget Accounting Standard 11. Now, this FCMITTA, that is nothing but the Foreign Currency Monetary Item Translation Difference Account, right. The exemption which is given by paragraph 46A, if the entity chooses as given under Ind AS 101. So, under Ind AS 101, we will also learn about this. Under Ind AS 101, the entity can choose to apply paragraph 46A given under AS 11. Basically, it can apply its earlier accounting policy. Now, tell me one thing, is this paragraph 46A a mandatory paragraph or it gives an option to the entity? The entity has an option under paragraph 46A to capture some foreign exchange differences into foreign currency monetary item translation difference account. Now, what are these differences we are talking about? We are talking about exchange difference which is arising on a foreign currency monetary item. And one thing, this difference has to be on a long term foreign currency monetary item. Say for example, there is a long term loan in foreign currency of, let us say, $100,000, right? Now, if this loan was obtained to acquire an asset, so say using this loan we have purchased an item of PPE, okay, and that day the exchange rate was say 80. So, our cost becomes 80,12123, which is nothing but INR 80 lakhs is your cost of PPE. Okay. Now, is this PPE a monetary item or a non-monetary item? This is a non-monetary item. So, there is no need to restate the PPE, but we have a foreign currency loan. Now, is this foreign currency loan a monetary item or a non-monetary item? It is a monetary item. Monetary item have to be remeasured. At what rate? At the closing rate. Now, when you remeasure it at the closing rate, there may be gain, there may be losses. Say for example, from this 80, closing rate is 85. Initial recognition rate is 80. What is the difference? 5 multiplied by $100,000, 5 lakhs. So, the loan repayable from 80 lakhs has now increased by another 5 lakhs. You have to pay 85 lakhs. Correct? From 80 lakhs, the loan balance has gone up to 85 lakhs. So, what is this? This is a loss on foreign currency monetary item. Now, what do we do with this loss? The entity has been given two choices. One, recognize in P&L. Now, the same treatment is given by Ind AS 21 also. Under paragraph 46A, the entity has an option to defer this amount and not recognize it in P&L immediately. So, what is the option available here? Under 46A, the entity has been given a choice. What is the choice? First is anyways P&L. If you want, you can take it to P&L. We don't have any problem. Otherwise, what you can do is, if it is related to a depreciable asset, then you can add or deduct it from the carrying amount. Now, what is the meaning of this? See, we have a loss of 5 lakhs. This 5 lakhs of loss, what you can do is, because it is pertaining to a depreciable asset, that is property, plant and equipment, add it or reduce it. Now, here it is a loss. So, if it is a loss, you have to add to carrying amount. If it is a gain, you have to reduce it from the carrying amount. So, why loss has to be added? Loss has to be debited somewhere, right? So, if you have to debit the loss, the value of the asset will go up. Or if it is a gain, the value of the asset will go down. Sir, can we choose 46A when there is a loss, and can we choose normal accounting when there is a gain? That is not allowed. Once you have chosen this, you have to continue to use it. Okay. So, under 46A, if it is pertaining to a depreciable asset, you will add it or reduce it from the carrying amount. If it is pertaining to a non-depreciable asset, then you will capture it in what? You will capture it in foreign currency monetary item translation difference account. account. This is also called as a component of equity as far as Ind AS 101 is concerned. Okay. So, you will capture it in the balance in FCMI TDA account has to be amortized over the remaining life. Okay. So, just to simplify this, what happens is, if at all there is a long term foreign currency monetary item, okay, and that results in an exchange difference, either a gain or a loss, one option is P&L, second option is 46A. 46A says, if it is related to a depreciable asset, add it or reduce it from the carrying amount. If it is related to a non-depreciable asset, take it to FCMI TDA account and amortize it over the remaining life, right. Now, if this treatment is followed, means the treatment for these monetary items, so this is a monetary item, this is a monetary item. If you follow this particular treatment, if the entity chooses the exemption given under Ind AS 101, then the accounting treatment for monetary item, that is to take it to P&L, does not apply. So, it may be a case where the entity is applying Ind AS 21, simultaneously also applying paragraph 46A of AS 11. Okay. So, that these are the two exceptions that you need to remember, and also obviously the NIFO thing what I told you, net investment in foreign operation. For this also there is a slight different treatment which we will come to it separately. So, to summarize, for monetary items except those covered under Ind AS 109 under hedge accounting, or for those cases where the earlier accounting given under paragraph 46A is followed, or something related to NIFO, except these three cases, you will recognize the exchange difference in P&L. For non-monetary items, you will check where does the gain or loss on that item go to. If it goes to the P&L, recognize it in P&L. If it goes to the OCI, recognize it in OCI. So, this is the summary of the treatment of exchange differences. Now that we have understood recognition and remeasurement, let's have a look at few questions based on those topics. Pretty simple questions. Very unlikely that such kind of questions would be tested in the examination frequently, but again, if these kind of questions come in the examination, it is a sure shot 6 marks or 8 marks question for you, because the concepts are pretty simple and doable. The tougher part or the complex part is around translation of financial statements that we will be doing subsequently. Okay, so these are pretty simple questions. By reading at the question itself, you can figure out that it will be very easy if at all they ask in the examination. So, let's see, on 30th of January of year 1, A Limited purchased a machinery for $5,000 from a USA supplier on credit basis. So, on credit basis a machine has been purchased. A Limited's functional currency is rupees or INR. Okay. The exchange rate on the date of transaction is $1 is equal to rupees 60. So, basically 5,000 multiplied by 60, it becomes 3 lakhs. Okay. The fair value of the machinery determined on 31st of March of year 1 is 5,500. Now, here if the company wanted, they could have determined the fair value in INR itself, but here they have said that they have done the fair valuation at 5,500. Okay, let's see subsequently. The exchange rate on 31st March of year 1 is rupees 65. Okay, so the fair value of the machine has also increased from 5,000 to 5,500, and the exchange rate has also gone up from 60 to 65. The payment to overseas supplier was done on 31st of March of year 2. When did we purchase? On 30th of January of year 1. When did we repay? When did we pay to the supplier? We paid to the supplier on 31st of March of year 2. So, that is after 1 year and 3 months. And the exchange rate on 31st of March of year 2 is $1 is equal to 67. The fair value of the machinery remained unchanged for the year ended on 31st March of year 2. Prepare journal entries for the year ended 31st March of year 1 and year 2 according to Ind AS 21. Tax rate is 30%. Now, why did they give us the tax rate? We are not required to compute any profit and loss. This tax rate is given because if you see subsequently, they follow revaluation model. The moment an entity follows revaluation model, what would happen? There would be a difference between the tax base and the accounting base. Sir, but tax depreciation is not given. Even if tax depreciation is not given, then even if you assume to be the same depreciation rate, to the extent of revaluation, there will be a temporary difference which will be created. So, it has been given for you to create a deferred tax entry. Okay. A Limited follows revaluation model in respect of plant and machinery. So, because it is a revaluation model, what will you do? You will consider 5,500 as the fair value multiplied by 65. That will be the value which you should be considering. A pretty simple question. They have asked us to pass journal entries for the year ended 31st March of year 1. Now, on 31st March of year 1, what would be the journal entry? 1, obviously the revaluation part. Second, we have not paid the supplier. We have not paid the supplier, and because we have not paid the supplier, there would be an exchange difference on remeasurement, and that has to be accounted as per Ind AS 21. Now, as we do the question, you will realize that if you follow a stepwise approach, such kind of questions are just a cakewalk. Okay, so let's get on to the solution. So, 30th January of year 1, cost of purchase in dollars is given to be 5,000. Exchange rate, the exchange rate is given to be 60. So, in INR terms, it will be 5,000 multiplied by 60. So, on the date of transaction, that is on 30th of Jan of year 1, your entry will be machinery account or property, plant and equipment account, debit by how much? 3 lakhs to creditor 3 lakhs. Okay, that is on 30th of January of year 1. Then the next thing that would happen on 31st of March of year 1. What are the things that would happen? First, this machinery, the property, plant and equipment, this has to be revalued. Sir, why are we not depreciating and all of that? Because information is not available. So, first you have to revalue, that is one thing. Second, this creditor is also a foreign currency monetary item. It's a foreign currency monetary item. Because it is a monetary item, it has to be remeasured using the closing rate. The property, plant and equipment is not a monetary item, it's a non-monetary item. But this property, plant and equipment, which is a non-monetary item, it is measured using what? Fair value. So, you will have to measure the fair value and apply which exchange rate? The historical rate or the fair value rate? The exchange rate on the date on which fair value is done, right? So, one is revaluation of machinery, second is remeasurement of creditor. Now, when we remeasure this creditor, which is a monetary item, what will we do with the exchange difference? Will we take it to the P&L or will we apply paragraph 46A of AS 11? Generally friends, if the question is asking as per Ind AS 21 and if no information has been given, you assume that the company is not opting for its earlier accounting policy under AS 11. Okay, please note, the AS 11 principles can be applied only if it was following those principles. Otherwise, if the company from its initial stage itself is applying Ind AS 21, then there is no question of applying AS 11, right? So, if the company was applying accounting standard 11 paragraph 46A, then that option comes into the picture. Otherwise, that option will not come into the picture. Okay, so on 31st of March of year 1, first what will you do? Revaluation. Now, what is the entry for revaluation? You have to see what is the amount of revaluation. So, revaluation amount $5,500 and the rate applicable is 65. So, the value will be, INR value will be 357,500. So, this is the revalued amount for PPE. Carrying amount is 3 lakhs. So, revaluation which will be credited to OCI will be 357,500 minus 3 lakhs. Now, this revaluation surplus of 57,500 will increase the carrying amount of the asset in the books. The tax base will not change. So, the carrying amount of the asset is greater than the tax base. This will result in what? This will result in what? This will result in a deferred tax liability, right? So, DTL will be at what rate? They have given 30%. So applying 30%, 57,500 multiplied by 30%, 17,250. Where will we take this DTL to? Will we take it to PNL or OCI? Was when revaluation surplus will go to OCI, the DTL will also go to OCI. That is the second thing. Then this creditor also needs to be restated. So amount payable to creditor is how much? 5,000 or 5,500? Amount payable is 5,000. What is the rate applicable? 65. So 5,000 multiplied by 65, this is 3,25,000. What is the carrying amount? Carrying amount is 3 lakhs. So exchange difference loss is 325 minus 3, 25,000. Why is it a loss? Because the liability value has increased. Earlier we had to pay 3 lakhs, now we have to pay 3,25,000. So we have to pay 25,000 extra, which is a loss. This loss will be debited to P&L. Please note, exchange difference on monetary items to the P&L, excluding those exceptions. And for non-monetary items, it depends on where does the gain or loss on the non-monetary item taken to, right? Now, on 31st of March, as I told, first one is the revaluation entry. So you will say machinery account, which is a PPE. What is the revaluation amount? Revaluation amount is 57,500 to OCI, 57,500. Then OCI debit to deferred tax liability 17,250 and 17,250. Then exchange difference loss debit 25,000 to the creditor balance has increased. So to creditors 25,000. Sir, such simple entries? Yes, simple entries. That's why I don't expect such kind of questions to appear in the examination frequently. Once in a while, it can be a bonus question, right? So this is as far as accounting as on 31st of March of year 1 is concerned. Okay. Then moving on, what happens on 31st of March of year 2? Fair value in dollar terms remains the same. That is 5,500, and which has to be exchanged, which has to be converted at 67, and you have to settle the transaction with the creditor, and the creditor is settled at again 67. So for these two we need to pass the entries. One more thing friends, I have prepared a table here so that it is easy for us to understand and follow, because this is the first question. As far as the exams are concerned, you can directly take it here itself. You can say the difference between the rate and the amount applied, whatever is the difference, you can directly write. Okay, so we will do that for 31st March of year 2. For 31st of March of year 2, first there is a revaluation. Revaluation means you can directly pass this journal entry, machinery PPE to OCI. What is the value? Here the value will be difference in exchange rate. Please note the value of the machine has gone up. So 67 minus 65. Why 65? 65 is the previous rate at which we had measured the machinery, multiplied by 5,500. This is the gain. So 2 multiplied by 5,500, 11,000 here and 11,000 here. The other way to do that is, of course, 67 multiplied by 5,500, compare that with the previous carrying amount and arrive at the surplus. Okay, so this is the revaluation surplus. Then on this deferred tax liability, DTL, OCI debit to DTL, deferred tax liability. Please don't write in short forms, write in full forms only. You still have to write the exams. I have already written. Okay, 11,000 multiplied by 30%, that is 3,300. So 11,000 multiplied by 3,000, 30%, 3,300 is the deferred tax liability. Then on this date itself, there is a settlement of transaction, payment to creditor. Now when we pay to the creditor, you will debit the creditor by how much? The closing balance. What is the balance in the creditor's account? Amount payable to creditor is now 3,25,000. Originally it was at 3 lakhs, now it is at 3,25,000. So 325 debit. How much will be paid to bank? You will have to pay 5,000 multiplied by 67. 5,000 multiplied by 67, you get 3,35,000. So exchange loss debit 335 minus 325, 10,000. The other way to do this is, you can actually first restate the creditor to 335 and make the payment entry. That is also perfectly fine, right? So simple question, nothing complicated, nothing complex. Common sense is that you need to apply to solve these kind of questions in the exam. Okay, even if you had not done Ind AS 21, I think these things you would have been able to do in the exam automatically. Let's move on to the next question. Let's have a look at another question. On 1st of January of 2018, P Limited purchased a machinery for $2 lakhs. Generally with dollars we write millions. Anyways, the functional currency of P Limited is rupees. At that date, the exchange rate was $1 is equal to 68. P Limited is not required to pay for this purchase until 30th of June of 2018. When did we purchase? 1st of January of 2018. When do we need to repay? 30th of June of 2018. What comes in between? Of course, 31st of March of 2018. So, you have to remeasure on that day. Rupees strengthened against the dollar. Strengthened, when we say rupees strengthened, then $1 will be equal to lesser number of rupees. Okay, basically dollar becoming cheaper. So, in the 3 months following the purchase and by 31st of March 2018, the exchange rate was $1 is 65. So, from 68 it has come down to 65. What does this mean? This means that you have to pay to the supplier lesser, right? You have to pay to the supplier a lesser amount. The CFO of P Limited feels that these exchange fluctuation would not affect the financial statements because P Limited has an asset and a liability denominated in rupees. Now, I don't know how did he become the CFO. He would have even if you would have learnt AS11, he would not be making such statements. Anyways, so the CFO says that because we have liabilities and assets in INR, there will not be any impact. And also both of them were initially at the same amount. He also feels that P Limited depreciate this machine over 4 years, so the future year end amounts won't be the same. So, I don't know this thing that machine will be depreciated over 4 years, okay. So, the future year end amounts won't be the same. Now, how does that matter? Asset, it is recognized separately, liability, it is recognized separately. The asset that you have recognized, you have converted that into INR and it will continue to remain in INR. The liability that you have recognized is a monetary item which has to be remeasured at the end of each accounting period. So, don't we need to remeasure the machinery? Unless you are following a revaluation model and you are calculating the fair value in dollar terms, there is no need to remeasure the machinery part, right? Examine the impact of the transaction on the financial statements of P Limited for the year ended 31st March of 2018 as per Ind AS. Now, when it is asked to examine the impact of this transaction on the financial statements, we have to see what happens at the time of initial recognition. What is the value at which we will initially recognize? Pretty simple. Then, on 31st of March, what would happen? One, you will have to remeasure the monetary item which is the payable. Second, the property, plant and equipment has to be depreciated, and because we are carrying it at historical cost, you will continue to measure this item using the historical rate. In other words, you will continue to measure that in INR, okay. Even if the exchange rate changes, the value of PPE will not change, right. Then you have to see what will happen to the exchange difference arising out of remeasurement of the payable. Where will you take that, okay. That is the overall impact of these transactions in the financial statements. So, let us just quickly note down particulars: USD or dollar, rate INR, okay. Cost of machine, it said 2 lakhs. So, 2, 1, 2, 1, 2, 3. Exchange rate was 68. So, first thing, the machine will be initially recognized at INR 1 crore 36 lakhs on 1st of Jan of 2018, and a corresponding liability of same amount will be recognized, right. That is when the transaction is entered into. Now, on 31st of March, what would happen? First, one thing is depreciation, second thing is remeasurement of liability. So, depreciation, how will you depreciate? You will depreciate using the cost model, and it says a useful life of 4 years. So, 1 crore 36 lakhs divided by 4 multiplied by Jan, Feb, March, 3 divided by 12. Why? Because only for 3 months. So, that comes to 8,50,000. The company would charge a depreciation of rupees 8,50,000. Okay. Sir, any deferred taxation impact? Have we been given the tax rate? We have not been given the tax rate, so no impact. Then, carrying amount of payable. How much is payable? 200,000. What is the rate? I think 65. Yeah, it is 65. So, 2 lakhs multiplied by 65, the carrying amount is 1 crore 30 lakhs. Now, what will happen when the carrying amount comes down from 136 to 130? There is a exchange gain. So, what is the exchange gain? ₹6 lakhs. The company will recognize an exchange gain of rupees 6 lakhs. Okay. So, for the financial year ending 31st of March of 2018, an exchange gain of rupees 6 lakhs will be recognized on remeasurement of monetary item, that is payable. So, can I also add carrying amount of PPE will be 136 minus 8,50,000, which is 1,27 lakhs 50,000, 1,27 lakhs 50,000, and exchange gain of 6 lakhs will be recognized, right. So, that is the impact on the financial statements of these transactions. You can also add a line saying that the contention of the CFO that both the assets and the liabilities are in INR and they are not required to be remeasured and all of that is not valid. So, if you look at the question says that the CFO feels that this exchange fluctuation would not affect the financial statement because asset and liability are denominated in rupees. So, what you can say is contention of CFO of P Limited is not correct because as per Ind AS 21, foreign currency monetary item are remeasured using the closing rate. The non-monetary items are carried using the historical rate. Hence, liability would be remeasured, but PPE would not be remeasured. Okay. So, this is how you will solve this kind of question. Again, a highly unlikely question in the examination. Let us have a look at another question. Supplier A Limited enters into a contract with a customer B Limited on 1st of January of 2018 to deliver goods in exchange for a total consideration of USD 50 million. So, USD 50 million is the total consideration and it receives an upfront payment of USD 20 million on this date. Okay. So, there is a contract, the total consideration is 50 million and 20 million has been received in advance. The functional currency of the supplier is INR. So, for A Limited, functional currency is INR. The transaction is happening in USD. So, you have to convert USD into INR. Simple so far. The goods are delivered and revenue is recognized on 31st of March of 2018. Okay. Advance of 20 million is received and the goods are delivered and revenue is recognized on 31st of March. Now, this is a case where as per Ind AS 115, the performance obligation are satisfied at a point of time because it says goods are delivered. So, they have delivered the goods and revenue is recognized on 31st of March of 2018. Now, what will be the value of revenue that should be recognized? That is one important question. Now, we know the total transaction consideration is 50 million. So, we will recognize 50 million. Now, the key question would be which rate should we consider to convert this 50 million USD into the functional currency, that is the INR. Okay. Now, think of it. Should it be 31st March rate? Should it be the 1st of January rate, or should it be partly 1st of January and partly 31st of March? The balance of US 30 million is received on 1st April 2018 in full and final settlement of the purchase consideration. State the date of transaction for advance consideration and recognition of revenue. Also state the amount of revenue in INR to be recognized on the date of recognition. The exchange rates on 1st January and 31st March are 72 and 75 per USD respectively. Okay. Now, we have to break this transaction down. We have to see the event. There are 3 events: 1st of January, 31st of March and 1st of April. We have to see what is the date of transaction for advance consideration and recognition of revenue. As far as advance consideration is concerned, the date of transaction is the date on which the advance consideration is received. It is pretty straightforward, right? So, the date relevant is 1st of January. When you recognize the advance consideration, you will see the USD rate of 72, apply it to $20 million and recognize the transaction, right? That is the first thing, because the exchange rate that is applicable will be the date of transaction, and as per Ind AS 21, the date of transaction is the first date on which the transaction qualifies for recognition as per respective Ind AS. So if you go to Ind AS 115, you will have to recognize a contract liability here because you have received an amount in advance, right? The consideration is received in advance, so it is a contract liability. When will you recognize the contract liability? You will recognize it on 1st of January. So which rate will you take? You will definitely take the rate on 1st of January. Then coming to revenue recognition, what is the relevant date for recognizing revenue? The date on which the performance obligation has been satisfied, and as per the question it is 31st of March. So on 31st of March you will recognize revenue. Now another important question here is, now when you recognize revenue, will you say 50 million multiplied by 75, or you will split into two parts, 72 for 20 million and 75 for balance 30 million. Now think of it. You received advance on 1st of January, that is the value that you have already received. There is nothing out of this which has to be refunded. Though you are carrying it as a contract liability, it is a liability to provide goods in the future. So for the advance that you have already received, the exchange rate, that is 72, will be relevant for recognizing revenue. That is the first thing, because you have already received that amount. Just because I am recognizing revenue in the future does not mean that the entire USD value has to be converted using 31st March rate. Okay, see, the impact on the P&L will not change whether you recognize everything at 75 or everything, or partly at 72 and partly at 75. Impact on P&L will not be different, because if you recognize everything at 75, then because you have received at 72, you will also be recognizing a corresponding loss. But because this first transaction was already recognized on 1st of January, the amount that you have already received is clearly determined, and only for the balance amount, only for the balance 30 million, you have not yet received the amount. So what you need to do is, as you recognize revenue, for the 20 million advance received, 72 will be the conversion rate, and for the balance 30 million, 75 will be the conversion rate, which is the rate on the date on which we have recognized revenue. So coming to the solution, for advance, recognition is on 1st of January of 2018. 1st of January of 2018, USD 20 million, USD 20 million, rate 72, rate will be 72. So INR you will recognize 20 multiplied by 72, 1440 millions, if you have to say in INR millions. Okay, this is the advance recognition. Revenue recognition will be on 31st of March of 2018. Okay. Now as far as revenue recognition is concerned, out of the total 50 million, you have to split it. Why? Because you will have to de-recognize this advance, which is a contract liability. You will have to de-recognize the contract liability and recognize revenue. So here first is de-recognition of contract liability and recognition of revenue, that is for 20 million at 72, 1440. Okay. Then second is recognition of balance 30 million revenue, that will be 30 and rate is 75, the value will be 2250. The total revenue that will be recognized is 3690. So just if you want to understand the entries, first entry will be debit contract liability by 1440, credit revenue 1440, and second entry will be debit account receivable by 2250, credit revenue 2250. Okay. Now as I told you earlier, if you converted entire 50 at 75, then you would be recognizing exchange loss because you have received lesser value, and net impact on the P&L will be the same. But this is a better approach to recognize the revenue, because you have already received this 1440, which is a contract liability, and when you recognize revenue, you knock off the contract liability and recognize the revenue, right? Some of you may get a doubt, sir, do we need to restate this contract liability because it is denominated in, because it is a foreign exchange transaction? Please remember, this is a non-monetary item. It is not a monetary item, because you are not paying back 20 million to somebody. you are providing services in return, right? So the liability does not have any fixed amount which has to be repaid. So it is a non-monetary liability, right? So you will recognize revenue of 1440 and 2250. Sir, what will happen on 1st of April? Say for example, the exchange rate from 75 came down to 74 for whatever reason. So for the difference of 1 rupee per dollar, you will recognize of foreign exchange loss. Okay. So this account receivable, because it is on 31st March, there is no need to restate. At the time of settlement, you will have to recognize the exchange difference as a gain or a loss in the P&L. Let's have a look at another question, a pretty interesting one, and these are the things that you would be getting in your day-to-day life. Okay. So these are the transactions that would keep on happening, and you have to see how to account for the transaction and how to measure the exchange differences. On 1st of April of year 1, Makers Limited raised a long-term loan from foreign investors. The investors subscribed for 6 million foreign currency loan notes at par. So, what is the amount of loan? 6 million or 60 lakhs in foreign currency, assume USD or something. Okay. It incurred incremental issue cost of foreign currency 2 lakhs. Means what? You have raised 60 lakhs of loan, you have incurred cost of 2 lakhs. So, what is the net received? What is the net amount which is received? 58 lakhs. Okay. Interest of foreign currency 6 lakhs is payable annually on 31st of March starting from 31st of March of year 2. So, every year you will pay interest of 6 lakhs foreign currency units at the end of the financial year. The loan is repayable on 31st of March of year 7 at a premium, and the effective annual interest rate implicit in the loan is 12%. Now, to step back from the question and explain you a concept that we will be learning as a part of financial instruments, there is a concept called amortized cost. Now friends, if you see here, though we have taken a loan of 60 lakhs, we have actually got only 58 lakhs, and in the future we have to repay it at a premium, and periodically we have to make interest payments. Okay. So what the standards require us to do is to find out what is the effective interest cost. See, actually if you see, 6 lakhs on 60 lakhs translates into 10% per annum, but we got lesser amount, so our interest rate will be higher, and also we have to repay it at a premium, then also our interest rate will be higher. So considering the entire inflow of transaction, cash inflow, that is 58 lakhs, cash outflow every year, which is 6 lakhs, and maturity repayment, we have to calculate something called as effective interest cost. This is nothing but your yield to maturity, what you can consider. Okay. So what is the effective interest cost or the IRR of the loan transaction? That is what we need to calculate, and here it is given to be 12%. So considering 12%, we have to do the accounting. The appropriate measurement basis for this loan is amortized cost, and the exchange rates are on 1st of April 2.5, on 31st of March 2.75. So we have taken the loan on 1st of April, that is of year 1. Okay. Average rate for the year is rupees 2.42. So average exchange rate is 2.42. Surprisingly, opening rates are also higher, closing rate is also higher, average rate is lower. Maybe the currency had gone down and then again it had picked up. The functional currency of the group is Indian rupee. Okay. What would be the appropriate accounting treatment for the loan in the books for the year 1-2? Calculate the initial measurement amount, finance cost, closing balance, and exchange gain or loss. A pretty simple question. Just you have to follow logically the steps that are involved. See, if it was an INR loan, what would you have done? You would have taken opening balance, add interest, less payment, then closing balance, right? Same thing we have to do in foreign currency terms. So let's get into that. So what we need to see is what is the initial recognition amount. Okay. So I'll just add a line here. In foreign currency, exchange rate, and in INR. What is the initial recognition? The question says 6 million loan raised, but 2 million of incremental cost. So it's like I have got 60 lakhs and I have to immediately pay 2 lakhs. So what is the net amount that I have received? I have received only 58 lakhs. So I'll take 58 lakhs. Okay, which is 5.8 million. What is the exchange rate? Now please remember, any foreign currency transaction will have to be recorded in the functional currency using the exchange rate on the transaction date. So what is the exchange rate on the transaction date? See, the transaction date is 1st of April, exchange rate is 2.5, so we will say 2.5. If you want, I can just put the date here also. 1st of April of year 1. Okay. So what is the equivalent in INR? 58 multiplied by 2.5, it comes to 1 crore 45 lakhs. This is the loan balance. So what is the entry? Bank account debit to foreign currency loan 1 crore 45 lakhs. Okay. Then interest at how much? At 12%, because that is the effective rate of interest. So we are paying only 6 lakhs, that is the outflow. Interest recognized can be different from the outflow that actually happens, right? So which is 58 lakhs multiplied by 12%, which comes to 6,96,000, right? So this is the interest cost, this is not the interest payout, this is the interest cost. So interest is 6,96,000. Now this interest has accrued throughout the period. So at what rate should we convert this in the financial statements? When we recognize this interest cost, do we take the opening rate or do we take the closing rate? Friends, because this has accrued throughout the period, it is better to take the average rate, because that is what represents the actual interest cost. So what is the average rate? The question mentions that the average rate is 2.42. So you have to consider 2.42 as the exchange rate. In INR it comes to 16,84,320. On 31st of March of year 2, you will recognize this expense. Interest expense debit to the loan account or to interest payable account. Okay. Then how much is the payment? Payment, if you see, will be 6 lakhs. That is what is paid, okay, in foreign currency. But what is the exchange rate for this payment entry? You have to check what is the date of transaction. Date of transaction is 31st March of year 2. And because it is 31st March of year 2, on that date we are making the payment. What is the relevant rate? The rate existing on 31st March of year 2, and that is given to be 2.75. 2.75. So when you record it in INR terms, it comes to 1650. So what has happened here? Loan of 1 crore 45 lakhs, interest expense is 1684, payment is 1650. Then what is the closing balance? Closing balance is opening balance plus interest minus payment, that is 5896 lakhs. 58.96 lakhs or 58 lakhs 96,000. Now this closing balance is in foreign currency. Now you have to think and tell me whether it is a monetary item or a non-monetary item. This foreign currency loan, whether it is a monetary item or a non-monetary item. Think of it and decide whether it is monetary or non-monetary. Then the next thing that you have to decide is, if it is a monetary item, what do we do at the year end? Now here, this particular loan is a foreign currency loan. The amount that is to be paid is determined in foreign currency terms. So it is a monetary liability. If it is a monetary liability, just recollect that we have to restate this amount on the closing date or at the end of the reporting period, considering the closing exchange rate. So this has to be restated. How will you restate this? Using the closing rate. What is the closing rate? 2.75. So what should be the closing balance? Closing balance after restatement will be 5896 multiplied by 2.75. You get 1 crore 62 lakhs 14,000. But what is the actual closing balance in the books? 1 crore 45 plus interest minus payment. Actual closing balance is only 1 crore 45 lakhs 34,320. Okay, so this has to be restated. So what is the difference? Difference is 16 lakhs 79,680. Now friends, this exchange difference, because our liability has increased, will be a loss. See, whenever an asset balance increases, it is a gain. Whenever liability reduces, it is a gain. Here liability has increased, so this is an exchange loss. So from this discussion, what can we understand? That the loan will be initially recognized at 1 crore 45 lakhs. The interest expense for the year in foreign currency is 696, which will be equal to 1684,320 in INR. The payment will be recognized using the exchange rate prevailing on the date of payment, that is 1650. The closing balance in the books before restatement is 1 crore 45 34,320. Because it is a foreign currency loan, because it is a monetary item, we have to restate the monetary item. After restatement, the balance comes to 1 crore 62 lakhs 14,000. And the difference between these two, that is 1679,680, will be the exchange loss. So if you look at the question, what have they asked? They have said initial measurement amount, you have to write the initial measurement amount is so much. Finance cost is so much in foreign currency and in INR. Closing balance in foreign currency is so much, in INR is so much. After restatement, this is the value, and exchange loss is here 1679,680. So friends, we have so far discussed about accounting for foreign currency transaction, how to initially recognize them, how to measure them, what to do at the time of free measurement, what to do with the exchange differences and related aspects. This is the simpler part of the standard. We will now move on to the complex part of the standard where a lot of students face difficulty. Now the difficulty is faced because the underlying logics and concepts are not learned rightly. If you start by-hearting these things, you will never be able to master this particular standard. In fact, this holds true for almost all the standards, and I have been, I think, telling this to you again and again that you have to learn things conceptually. Okay. Now the next topic that we will be taking up as a part of this standard is translation. Now you might be wondering, sir, we have already done translation. From USD we have translated the amounts to INR. Yes, we have done that, but that is with respect to specific transaction. So far what we have done are the conversion of foreign currency transactions which are entered into by the entity. So say for example, we have an Indian company, it has exported certain items, that is the transaction entered into by the company, and we have converted that foreign currency transaction into the functional currency. The thing that we will be understanding now is translation of financial statements. You can understand it this way. Translation of what? Financial statements. Now it can be trial balance, it can be profit and loss, it can be balance sheet, but what we are doing? We are translating financial statements into the functional currency. Now the next question is financial statements of what? Financial statements which are not in the presentation currency, or maybe the financial statements of a foreign operation. Okay, these are the two aspects we will be dealing with. These are the two aspects that we will be dealing with. First, the accounting is done in functional currency and the presentation currency is different. Second, there is a foreign operation for which we have to do the translation. The logic, the principles would be by and large similar when we talk about these two items. So let's now understand how do we translate a financial statement from a functional currency to the presentation currency. First, let's take a very simple example. Say there is an Indian company. Okay. And this Indian company has a functional currency which is say USD. Okay. Now the presentation currency is INR. Tell me, now first thing that we need to understand is all the accounting transactions that will be recorded in this particular currency which is USD. You will not record any transaction in INR. So what if the transaction itself is in INR? Even that you have to convert into USD and record it, because accounting will be done in the functional currency. That is the first thing. Then say for example, there is a foreign currency transaction and this transaction is in GBP. So the entity is entering into a foreign currency transaction which is in GBP. Functional currency is USD, presentation currency is INR. Now, so far what we have understood or what we have discussed is converting this foreign currency into the functional currency. So, say for example, the company has sold GBP 1000 worth of goods, and now say for example the exchange rate is 1 GBP is equal to 1.5 USD. Okay. Now when 1 GBP is equal to 1.5 USD, what will happen? This 1000 of GBP will be recorded as sales as 1500 USD. So you will pass the sales entry at 1500 USD. But then will you prepare the financial statement saying that the revenue is 1500 USD? It cannot be done. You have to present the financial statements in INR. So if you have to present the financial statements in INR, you have to first prepare the financial statements in functional currency, and you have to translate these financial statements from the functional currency to the presentation currency. So what happens? This is a transaction. Please understand this difference again. From foreign currency to functional currency. So please keep this in mind. From GBP, that is the foreign currency, to the functional currency, whatever we are doing, this is an accounting for transaction. Okay. Then from functional currency, when we have to convert it into INR, because we have to present the financial statements in INR, this is called translation. See, in a way even this is translation, but that is accounting for a foreign currency transaction. Here it is translation of a foreign currency transaction. So we need to understand how do we translate financial statements and present them in the presentation currency. Sir, if functional currency is same as the presentation currency, then no need to translate. Okay, there is no question of translation of financial statements. Another scenario what can arise is that, say there is an Indian company, let's say there is an entity, say it is a parent or father, okay, just for understanding purpose. Then this entity has a branch, it's a foreign operation, say this is the child, okay. Now when this entity, the father entity, when it has to present the financial statements, it will also include the financial statements of child. Now say for a moment that father, the presentation currency applicable is INR, functional currency is also INR, okay. This child is in US and the functional currency is USD. So what we need to do? We need to take this USD financial statements, translate that into INR, which is the presentation and the functional currency of the parent. So sometimes what may happen is foreign operation has functional currency as USD, parent has functional currency say GBP, just for example, okay, and presentation happens in INR. So now here what happens is the foreign operation, the functional currency is USD, this firstly you have to convert into GBP, that is the parent's functional currency, and then you have to convert into INR, which is the presentation currency. This is the most most widely adopted approach. Some of them may say that directly USD to INR, but this is a more proper approach, that is a step-by-step approach from the foreign operations to GBP, from the functional currency of the branch to the functional currency of the parent, and from that to the presentation currency of the parent. Okay. Now, don't get confused between what we learned earlier when we accounted for foreign currency transaction. No, we accounted for transaction at the exchange rate, prevalent on the date of the transaction. Then we understood that, for monetary items, you have to do a subsequent measurement using the closing rate. And for non-monetary items, there could be a P&L recognition or OCI recognition. That is for transaction. That is like the entity, the parent company or the reporting entity itself entering into a foreign currency transaction. When we are talking about translation, what we will be understanding now, we are converting financial statements from one currency to another currency. In most of the cases, it will be the functional currency to the presentation currency, or the functional currency of the branch to the currency of the parent, right? That is what we are understanding now. We are not talking about individual specific transaction, we are talking about financial statements as a whole, and more often these kind of questions is what will be tested in the examination than a simple foreign exchange transaction. So one last time, the difference between these two is, first, there is a foreign currency transaction where the entity is entering into a transaction. Second, there is a translation where there is a translation of the financial statements. Here transactions are not being converted. In the second case, we are taking up a financial statement and we are translating the financial statements. That is what we will be understanding now. So now that we have understood the meaning of translation and why do we do the translation, we need to understand what is the principle for translating a financial statement from one currency to another currency. Generally, as I told you, it will be from the functional currency to the presentation currency, or of a foreign operation to the functional and the presentation currency. So the principles which are given by Ind AS 21 are pretty simple. You just need to take line items of the P&L and the balance sheet and convert them one by one. So as far as assets and liabilities are concerned, you have to take the closing rate. So closing rate of which date? Balance sheet date. So exchange rate will be closing rate and date will be the balance sheet date. Meaning to say, if you are preparing financial statements for 31st of March of year 2, then you will take the exchange rate of 31st of March of year 2. Say for example, you are presenting balance sheet as comparatives. So you have 31st of March of year 2 and you also have 31st of March of year 1. Okay. Now this is the balance sheet as on 31st of March of year 2. Okay. Now here it is clear, assets and liability will be closing rate. Here which rate will you apply? Here also you will apply the closing rate. But which closing rate? The closing rate as on 31st of March of year 1. You will apply the closing rate as on 31st of March of year 1 and not 31st of March of year 2. So comparatives will be presented using the closing rate on that particular date. So you will take closing rate of this date. So we will take the closing rate of 31st March of year 2 for the current balance sheet and 31st March of year 1 for the comparative balance sheet. This is if the currency is not a currency of hyperinflationary economy. What is that? We will come to it separately because it is not really important from your exam point of view, because anyways Ind AS 29 is not applicable. So, we will just understand what is the meaning of hyperinflationary economy and what do you do in that case. But generally, this is the principle that you follow. So, for assets and liabilities, closing rate which is on the date of the balance sheet date. Then, for profit and loss items, you will take the exchange rate on the date of transaction. Each transaction, what is the exchange rate? So then, is it not like we are taking one transaction and converting that into our functional currency? Yes. For P&L items, you have to convert each transaction from the functional currency to the reporting currency using the exchange rate on the date of the transaction. So then, what is the fun in preparing the financial statements in functional currency? See, the reason why we prepare financial statements in functional currency or record the transaction in functional currency, because the functional currency is the currency which impacts the entity. So that is why the transactions are reported in functional currency. A first set of financial statements may also be prepared in functional currency and then they are translated into the presentation currency. Okay. Now, in case of a lot of companies, you will have thousands and lakhs of transactions. If you start converting each and every transaction, it becomes really cumbersome. So what we can do is, you can also take an average rate. Provided the currency is not fluctuating highly, you can take the average rate with respect to each of those transactions. So if I were to ask you, if you have to translate sales, what rate will you use? You will use the average rate. If you have to translate purchases, what rate will you use? You will use the average rate. If you have to translate debtors, what rate will you use? Closing rate. If you have to translate fixed asset, what rate will you use? You will again use the closing rate. Okay. Don't think that non-monetary item, the date of transaction, no. Balance sheet items, that is assets and liabilities, using the closing rate. Now, which rate will you use to convert equity? I am repeating, which rate will you use to convert equity? We said assets and liabilities closing rate, profit and loss items individual transaction rate. What about equity? Equity will be carried at its historical amount. Okay, you will not convert or you will not apply any rate to the equity. That is, equity is the number which will not change. Only thing that gets added is the P&L for the period or OCI for the period, that will get added, but you will not translate equity. So if equity in presentation currency was 1 lakh, you will continue to show that as 1 lakh in the financial statements. Now, after doing all these translations and conversions, what would happen is, you are converting one leg of the transaction using one rate and the other leg of the transaction using some other rate. Say for example, just for argument's sake, say for example, we have sales $1,000, okay, and debtors $1,000, and dollar is the functional currency. Okay. Now, what are we saying? We are saying that when you convert from the functional currency to the presentation currency, use different rates. One is, for the sales, use the rate on the date of transaction. Assume it is 75. So 1000 multiplied by 75, you get 75,000. Debtors, use the closing rate. 1000 multiplied by, say the closing rate is 78, it is 78,000. What the standard says is, because of this, there will be differences at the time of translation and the difference will have to be accumulated to OCI. So the difference, whatever is there, 78 minus 75, 3000 balancing figure will be accumulated in OCI. the difference of 3000 will be accumulated in OCI. Okay, so that is one thing you have to remember. It will not be taken to P&L when there is a translation of a financial statement from one currency to another currency. That is most likely the case where I said from functional to presentation or of a foreign operation to the functional of the parent. The difference that arises will be accumulated in FCI. This is generally written as FCTR, that is foreign currency translation reserve. Okay, till when can we carry? In case of a foreign operation, till the time you dispose of the foreign operation, you will continue to show it as FCTR. In case of conversion from functional to presentation only of the same entity, till the time the entity exists, this OCI will continue to exist, right? So the translation, if I have to summarize once again, assets and liabilities, closing rate, profit and loss items, individual exchange rate or average rate of the transaction, equity, historical values. You will continue to carry equity. When I say equity, your share capital, your reserves, whatever is the historical value will continue to carry that, which means if in the current period you have converted some P&L balance using the current exchange rate, the average exchange rate, in the next year you will not again recompute that. You will continue to carry it at the historical cost or historical values only. Now, this principle that I told you, that is the conversion from a functional currency financial statement to presentation currency financial statements, same logic, same principle will apply if you have to incorporate the financial statement of a foreign operation into the parent financial statements. Now, I have been using this term called foreign operation quite often. What is this foreign operation? Foreign operation can be a subsidiary, it can be an associate, it can be a joint venture, or it can be a branch of the reporting entity which is conducting its business in a country or in a currency other than that of the reporting entity. So, put it very simply, if the reporting entity is, let us say, in India and it has a branch in the US, because the branch is in a different country, it becomes a foreign operation. Or say for example, the company is in India and the functional currency of this reporting entity is INR. The branch is also in India, but the functional currency of the branch is USD. So why? Because the branch has exposure to, let us say, US economy, all the transactions are done out of, based out of US. So this branch specifically has the functional currency USD. So though both of them are in India, because the branch has a different functional currency, this branch also becomes a foreign operation. So a foreign operation can be a subsidiary, associate, joint venture or a branch which is conducting business or which is carrying out its operation in another country or in another functional currency. Okay, that is when we call these subsidiary, branches, the joint venture, associates as foreign operation. Now we'll have a look at a question and see how do we translate a financial statement from some another currency to the reporting entity's currency. Let's have a look at another question. Infotech Global Limited has a functional currency of USD. So we are talking about what? Infotech Global Limited, the functional currency is USD and needs to translate its financial statement into the functional and presentation currency of Infotech Inc. L dollar. So most likely this Infotech Global Limited is a subsidiary and we have to convert these financial statements of Infotech Global Limited into the functional currency and presentation currency of Infotech Inc. which is L dollar. So from USD, which is the functional currency of this entity, we have to convert the financial statements to the L dollar, which is the currency of Infotech Inc. Okay. So they have given us property, plant and equipment, receivable, total assets, issued capital, opening retained earnings, that is at the beginning of the period, P&L, profit for the period, accounts payable, accrued liabilities and total equity and liabilities 985. And if you see here carefully, for issued capital, they already have given us local currency values, that is the currency of what? This Infotech Inc. or the currency to which we have to convert it. So L dollar, so issued capital is already converted and given to us, and the opening retained earnings is also given to us as 15,274. Opening retained earnings will not convert again. To this opening retained earnings, what you will do is the current year P&L, you will convert that into L dollar and you will add that to the opening retained earnings. Okay. So all of these have been given, we just need to convert these from USD to local currency dollars. And what have they said? They have said that translate the above balances of Infotech Global Limited into L dollar, ready for consolidation by Infotech Inc. So you will convert this from USD to L dollar and Infotech Inc. would already have a financial statement of its own in L dollar, and then you will simply consolidate that. Otherwise, you cannot add up USD values and the parent company's values, right? That is what you have to do. And they have told that, share capital and opening return earnings are pre-populated. Even if they don't say, you can assume it. And prepare a working of the cumulative balance of the foreign currency translation reserve. So then after translation, you have to prepare a reconciliation kind of a statement showing the components of foreign currency translation reserve. So let's get into it. And yes, they have given this additional information. Exchange rate at beginning, L dollar 1 is equal to USD 1.22. Then average rate is 1.175 and rate at the end of the year is 1.13. Now friends, please note we are converting from USD to L dollars, and they have given us value of L dollar 1 is equal to USD so much. So if you have to convert from USD to L dollar, you have to divide and not multiply, because exchange rates have been given as L dollar 1 is equal to USD 122. So 1 L dollar is USD 1.22. So USD 1 will be L dollar 1 divided by 1.22. So accordingly, for all of these, you have to do the divisions and not multiplication. Another kind of silly mistakes what students tend to do in the examination in hurry bari. They always think that all exchange rates are based on 1 USD is equal to how much? 1 USD is equal to so much INR, 1 USD is equal to so much GBP. It is not like that. You have to look at the information and you have to do the translation. So let's get into it. So to quickly revise the translation principles, assets and liabilities, closing rate, equity and opening rate and earnings, you will not touch. Profit and loss, we will use the average rate because it has the transactions have happened throughout the period, as simple as that. So particulars, USD amount, exchange rate, L dollar amount. Okay. So coming to the particulars, property, plant and equipment. How many USDs? 50,000 USDs. I am just noting them down quickly. Receivables 935. Okay, so the total 985. Then issued capital 50. Opening retained earnings 28. Now here exchange rate is not applicable. Okay, so you will take directly the value which are given 30,055 and 15,274. Okay, then profit for the year 20,000. Profit for the year 20,000 and accounts payable AP 840 and accrued liabilities 47,000. Now this is a tallied financial statements presented in USD, which we have to now convert into L dollars, right? PPE closing rate. What is the closing rate? The closing rate that is the rate at the end of the year is 1.13. Please note we have to divide and not multiply, okay, because exchange rate is not given as $1 is equal to 1.13 L dollars, it is given as 1 L dollar is equal to 1.13 USD. So you can do this and you can divide it by 50,000 divided by 1.13, 44248. So here you can say USD divided by exchange rate, okay, 44247.79. Receivables again closing balance 827,433. Whether it is monetary, non-monetary, whatever it is, you have to take the closing balance. Then profit for the year, you will not take the closing balance, you will take the average rate. What is the average rate? 1.175. So that will become 17,021. Accounts payable, again the closing rate 1.13 and accrued liability is also 1.13. So it will be so much. And if you do the total here, basically, you can use the calculator and do the total, you get 847,306.03. That is, adding all of these 30,055 plus 15,274, 17,021, 743, 362, 41,592, you get 847,306. I know you can pause the video and do the calculation because I don't see any value addition if I start doing, calculating all of this manually. Pause the video, do the calculation and then continue. Okay. And here, you see that the total is 871, 681, that is 44, 247 and 827, 433. Now, the biggest problem arises, that is the balance sheet is not tallying, and that is one of the largest problem what students face even in normal times. Here we are converting and the balance sheet is not tallying. Why is it not tallying? See, one important component here, profit for the year, we have translated using 1.175, that is the average rate. Rest all things we have translated using the closing rate. That is one problem. Second, we have carried everything at historical cost. So, because of these, there is a difference in the balance sheet, and whatever is the difference, the balancing figure will be shown as a component in other comprehensive income as a foreign currency translation reserve. Those of you who would be working in MNCs where you have to do the consolidation, this is one item which will come up again and again, and it is subject to significant scrutiny at the time of audit, because you can just change the reserves balance by playing around with the foreign currency trial balances, right? So, though it is a balancing figure, just don't try to do a balancing figure, try to think through and understand whether actually there is a foreign currency translation reserve. So, here 847 and 871, 681. So, obviously the liabilities, equity and liability side is lesser. So, here you will have, can add one more item, that is FCTR, which is the OCI, other comprehensive income. That is the difference between what? 871, 681 minus 847, 306, that is 24, 375.39. So, if you paste it here, you can't copy paste, okay, I can copy paste, you cannot copy paste. So, that will be, so I need to 871, 681. So, this is the most important part here, which is your FCTR, that is foreign currency translation reserve, OCI balance 24, 3. So, this is the most important part here, FCTR balance, which is 24, 375. Where will you show it? Under reserves. Till when? Till the time this entity disposes of this subsidiary or loses control of this subsidiary. Okay, you will show this under OCI 24, 375. Now, the question also asked us to prepare a working of this FCR. So, we have to prepare that working of FCTR. Now, what are the items contributing? 1. Profit for the year. Second, the opening balance of issued capital and retained earnings. Okay. So, what is the closing balance of each of these? Profit for the year is 20,000 in dollar terms. Then retained earnings is 28,000. Then issued capital is retained earnings is 28, issued capital is 50,000. Okay. Now, this, if we apply closing rate, what happens? Closing rate is 1.13. Okay. What will be the value? If we apply closing rate, the value will be 20,000 divided by 1.13, which is 17,699. Here it will be 44,247 and here it will be 24,778. Okay. Actual. Then this is the L dollar using closing rate. Then what is the amount presented? Amount presented is, for the profit, amount is 17,021. For issued capital, the amount is 30,055, and for this the amount is 15,274. So, these are the three items which are presented. So, what is the difference? 17,699, which should have been presented using the closing rate, you are presented as 17,021, which is 677 difference. Here the difference is 14,192 and here the difference is 9,504. So, if you sum this up, the difference comes to 24,375.39, which is the difference which is presented here. Okay. So, if you see, the difference arises because you are converting some rates at a different rate, 1.1750. Here the rate is not applied, you have taken the historical amount instead of presenting everything at 1.13. So, this is the breakup of your difference. Okay. That is what you need to prepare as a working.